Understand the statements of financial position, record assets and liabilities on the specified date. Double entry bookkeeping part A. In this lesson, you will understand outline the double entry system and bookkeeping process of utilizing the double entry system. Prepare ledger accounts, post transactions, ledger accounts, balance, ledger accounts as required, interpret ledger accounts and differences. The trial balance. Understand that the trial balance is a statement of ledger balances of a particular and outline the uses and limitations of trial balance. Prepare a trial balance between these two balances. Prepare a trial balance which contain errors. Identify and explain those errors which do not affect the trial balance condition. Compensate accounts to the subordination originality. Recognize the division of ledger into the sales ledger, the purchase ledger, and the revenue ledger. Explain the use of and process of information. Distinguish between account for trade discount and cash discount. Explain the difference between cash deposit for liability and the ledger value for bank and cash. Explain the use of letter record and payment assessment and transfers and other electronic means. Petty cash books using explain the use and process of creating the petty cash book. Explain the definition. So business documents. Recognize and understand the following business documents: invoice, debit note, report, statement, account, check, receipts. Complete pro forma business documents. Understand the use of business documents as source of information, account for trade discount. Books of revenue. Understand the use of business documents as source of information. Explain the advantage of business documents of revenue. Explain the use of revenue and process accounting detail. Books of revenue, sales and purchasing, sales and purchasing. Post the ledger entries. Books of revenue and trade discount. The trial balance. Understand that trial balance is a statement of ledger balances on a particular date. Outline the uses and limitations of trial balance. Prepare a trial balance and accumulation balances and trial balance errors. Identify and explain those errors which do not affect the trial balance condition. Compensating accounts plus information originality principle. Join Discord server for one-to-one classes. Chapter 8 Financial Statements Part A. Explain the advantages and disadvantages of operating as a sole trader. Explain the importance of preparing income statements. Explain the difference between a trading business and a service business. Prepare income statements for trading business and for service businesses. Make adjustments for goods taken by the owner for own use. Balance ledger accounts as required and make transfers to financial statements. Financial Statements Part B. In this lesson, you will learn explain the importance of preparing statements of financial position. Understand the statements of financial position, record assets and liabilities on a specified date. Recognize and define the contents of a statement of financial position: non-current assets, intangible assets, current liabilities, non-current liabilities, and capital. Understand the interrelationship of items in a statement of financial position. Prepare statements of financial position for trading businesses and SME business. Accounting rules. Explain the recognize the application of the following accounting principles: business entity, consistency, duality, recurrence, and historical cost, matching principle, materiality, money measurement, prudence, realization. Recognize the influence of international business standards. Understand the following objectives and selective accounting principles. Policies, comparatively relevance, reliability, understanding. Distinguish between account for capital expenditure and revenue expenditure. Distinguish between account for capital asset and revenue receipts. Calculate and comment on effect of profit on incurrent treatment. Calculate and comment on effect of assets evaluation on incurrent treatment. Understand the basis of valuation of inventory at the lower cost and net realizable value. Chapter 11 Other payables and other receivables. Recognize the importance of matching costs and revenues. Prepare ledger accounts to record accrued and prepaid expenses. Prepare ledger accounts to record accrued and prepaid incomes. Make adjustments for accrued and prepaid expenses and accrued and prepaid incomes. In this lesson, you will learn accounting for depreciation and disposal of non-current assets. Define depreciation, reasons for accounting for depreciation. Describe the straight line method, risk balance method, realization method of depreciation. Ledger accounts for provision of depreciation. Preparation of ledger accounts to record sale of non-current assets, including the use of disposable accounts. Make adjustments for provision of depreciation and state liabilities and balance sheet valuation results. Irregular dates and provision for doubtful debts. Understand the meaning of irregular dates and recovery of bad debts. Prepare ledger accounts to record irregular dates. Prepare ledger accounts to record recovery of bad debts. Reasons for maintaining provision for doubtful debts. Prepare ledger accounts to record creation of adjustment to provide doubtful debts. Make adjustments for recovery dates and provision for doubtful debts. For one-to-one classes, please join Discord server.
Chapter 1, Part 1 contains bookkeeping, accounting, statement of financial position, capital, assets, liabilities, accounting equation, financial statements. Bookkeeping. Bookkeeping is a process of detailed recording of all the financial transactions of a business. Accounting uses the bookkeeping records to prepare financial statements at regular intervals. Statement of financial position. The owner of the business also needs to know the financial position at regular intervals. So a statement of financial position is prepared. This shows what the business owns and what is owing to it, its assets, and what the business owes, its liabilities. The term financial statement is often used as a collective name for an income statement and a statement of financial position. Capital. When a person decides to start a business, will have to provide the necessary funds resources. This is often in the form of monetary funds that may consist of buildings, motors, goods, and so on. Any resources provided by the owner of the business are known as capital. These represent the amount owed by the business to the owner of the business. Assets. Once the business is formed in capital entity, the business will own the money or other items provided by the owner. Things owned by the business or owed to the business are regarded as the resources of the business or the assets of the business. Example: machinery used in production, building used in for office, computer used for accounting work. Liabilities. In addition to the owner, other people may also provide assets to the business. The amount owed by the business to these people is known as liabilities. Example: loan taken from bank. The accounting equation: assets is equal to capital plus liabilities. The accounting equation: assets is equal to capital plus liabilities. Like any other mathematical equation, the two sides of equation will always be equal. The formula for this equation is assets is equal to capital plus liabilities. Capital is sometimes referred to as owner's equity. So the previous equation can also be written as assets is equal to owner's equity plus liabilities. Like any mathematical equation, the accounting equation can be used to find any one of the three elements if the other two are present. This equation illustrates that the assets of a business, the resources of the business, always equal to the assets and liabilities. Liabilities of and capital of a business. The resources provided by the business standards. The assets represent how the resources are used with the business, and the liabilities and capital represent where these resources come from. The statement of financial position. The accounting equation is shown in the form of a statement of financial position. This shows the three elements of accounting equation: the assets, the liabilities. Double entry system of bookkeeping: debit is equal to credit, ledger format of a ledger, two sides of a ledger, double entry records of assets and liabilities, double entry records for expenses and revenue, double entry records for drawings, balancing ledger accounts, double entry records for sales, goods sold and returns, inventory accounts, goods purchased for cash or check, goods purchased on credit. Trade credit or accounts payable, goods sold on credit, cash for cash, check, goods sold on credit. Trade data, accounts receivable, purchase return, accounts sales return, return on good, inward carriage, inward carriage outward, 3-column running balance account, format of 3-column running balance account. Double entry system of bookkeeping. A business would find it impossible to prepare a statement of financial position after every single transaction. The day-to-day transactions are recorded in the books of a business using double entry system of bookkeeping. The term double entry is used because the two effects of a transaction, a giving and a receiving, are both recorded in the ledger. Debit is always equal to credit. Debit is equal to credit. In order to record the two aspects of every transaction is entered twice on the debit side of one account and on the credit side of another account. The account which is receiving or gaining the value is debited. The account which is giving the value is credited. A ledger. The business maintains a separate ledger account for each type of asset, expense, liability, and income, and also for each individual debtor and creditor. Every transaction is recorded in the ledger account relating to a particular item or person. A ledger is traditionally a bound book where each account appears on a separate page. Over the years, the ledger has developed into a loosely paged folder with separate sheets, each containing a ledger account. Recent developments have seen the introduction of computer file divided into separate ledger accounts. Format of ledger. This is the format of ledger. Two sides of a ledger, debit side and credit side. Ledger account is divided into two sections. This can be shown by a central vertical line. The left hand side is known as debit side and the right hand side is known as credit side. The term debit is usually abbreviated to DR and the credit is abbreviated to CR. On either side of the account, there are columns to record the date, details, and amount of each transaction. The folio number column is used for reference purposes. The use of folio number is not required when answering questions. Double entry records for assets and liabilities. The ledger account is open for each type of asset and liability, applying the double entry principles. Every transaction is entered twice. The account which is receiving the money is debited. The account which is giving the money is credited. Double entry records for expenses and income. A ledger account is open for each type of expense and income. The same double entry principles apply to assets and liabilities are applied to expenses and income. The account which is receiving the money is debited. The account which is giving the money is credited. Double entry records for drawings. Whenever the owner of the business takes value from the business for their own use, this is known as drawing. This value may be in the form of money, non-current assets, or goods from the inventory held by the business. It is usual to open a drawings account to record these values so that the capital account does not have a large number of entries. Any drawings are debited in the drawings account to show the value going into that account. Then the credit entry will be in the account giving the value. When money is withdrawn, either the bank or cash will be credited. When a non-current asset is withdrawn, the appropriate non-current asset account will be created. When goods are withdrawn, the purchase account will be created. This is because these goods were originally purchased for resale and the amount of goods available for resale is reduced when goods are taken by the owner. At the end of the financial year, the total of the goods account is transferred to the capital account. This reduces the amount owed by the business to the owner. Balancing ledger accounts. At the end of each month, it is usual to balance any account of assets and liabilities which contain more than one entry. The balance is the difference between the two sides of account and represent the amount which is left in that account. Double entry records for sales, purchases, and returns. It is necessary to open an account to record goods which are purchased for resale and also an account to record goods which are sold by the business. Double entry records for sales, purchases, and returns. While these are actually the same goods coming into the business and going out of the business, it is necessary to have a separate account where the purchases will be at cost price and the sales at selling price. At purchase account and a sales account are either used rather than goods account. The same double entry principle applies to assets and liabilities are applied to purchases, sales, and returns. Inventory. An inventory account is only used to record the goods left at the end of the financial year and not for day-to-day transactions. Goods purchased for cash or check. Whenever goods are purchased, the purchase account will be debited if the goods are coming into the business and the purchase account is receiving that value. The double entry will be credited in either the cash account or the bank account depending on whether the amount was paid in cash or check. Goods purchased on credit. It is common for business to buy on a credit and pay for the goods at a later date rather than at the time of purchase. The purchase account will be debited in the HL. Trade creditors account for the credit entry will be made in the account of the supplier of the goods to show the value coming from that person. The supplier of the goods is known as trade creditor account payable. When a payment is made to the supplier, the bank account will be credited to show value going out of that account. And the account of the supplier will be debited to show value going into that account. Goods sold for cash or check. Whenever goods are sold, the sales account will be credited as the goods are going out of the business and the sales account is giving out the value. The double entry will be of debit in either the cash account or the bank account depending on whether the amount was received in cash or by check. Goods sold on credit. Just as the business may purchase goods and pay for them at a later date, it may also sell goods on credit. The sales account will be entered in the usual way. Debit entry will be made in the account of the customer, accounts receivable to whom the goods are sold to show the value going out to that person. Trade debtor or accounts receivable. The customer who bought the goods on credit is known as trade debtor. When a payment is received from the debtor, the bank or cash account will be debited to show value coming into that account and the account of the debtor will be credited to show value going out of that account. Purchase return or return outward of goods outwards. Sometimes goods which have been purchased have to be returned to the supplier. This may be faulty, damaged, or not what was ordered. These goods are known as purchase returns or return outward. A special account known as purchase returns account or return outward account is opened and any returns are collected to this account to show the value in it. The revenue entry will be made in the account of the seller to whom the goods are being returned to show the value in to that person. Sales return or return in note or goods in note. Similarly, a customer may bring goods to the business. These goods are known as sales return or return in notes. An account known as sales return account or return is open and any returns are debited to this account to show the value coming in. The credit entry will be made in the account of the customer who returned the good to show the value coming to that person. Double entry records for carriage inwards and carriage outwards. The term carriage refers to the cost of carrying of transportation goods. Carriage inward is part of the cost of purchasing goods, which occurs when a business has to pay for goods it has purchased to be delivered to its premises. Double entry records for carriage inwards and carriage outwards. Carriage outward is a selling expense that occurs when a business pays for goods to be delivered to the customer's premises. It is important that these two expenses are treated separately in the accounts. Carriage inward, carriage outward. Goods cost. Carriage is the cost of transporting goods. Carriage inward the cost of bringing the goods to the business, and carriage outward the cost of delivering the goods to the customer. We call them running balance accounts. The ledger account presented so far have been in traditional form. This is also known as the T account form. There is another method of presenting ledger account which is commonly used in commercial generated accounts, which is known as 3-column running balance format. The form of presentation is only one column each for the date, detail, and folio, and has 3 money columns side by side, one for debit, one for credit, and one for balance each transaction. The advantage of this method is that it shows the balance of that account after every transaction, and the account are prepared manually. It involves extra calculation into errors. Part 1. Contents: a trial balance, format of a trial balance, the purpose, imbalance trial balance, balance trial balance, error of commission, error of complete reversal, error of commission, error of originality, error of principal compensating errors. A trial balance. It is important to remember that the trial balance is not a part of the recording system, as it is simply a list of balances. If the ledger accounts are balanced monthly, then a trial balance may also be drawn up at the end of each month. The trial balance should be headed with the term trial balance along with the date on which it was prepared. Format of trial balance. The purpose of a trial balance. The trial balance can help in locating arithmetical errors. However, the balancing of the trial balance is not proof that entries in the ledger accounts are completely free from errors. The trial balance is useful in preparing financial statements. Trial balance and errors. The trial balance and errors. If the trial balance fails to balance, when trial balance fails to balance, it is obvious that an error has been made somewhere. This may be an error of addition within the trial balance, an error of addition within one of the ledger accounts, entering a different figure on the credit to that entered on the debit when making a double entry in the ledger, making a single entry for a transaction rather than the entry, entering a transaction twice on the same side of the ledger. Balanced trial balance. And a balanced trial balance balances simply means that the total of the debit balance is equal to the total of credit balances. It does not imply that the double entry is error free. The trial balance will still have balance if any of the following errors are made. Error of commission. This occurs when a transaction is entered using the current amount on the correct side but in the wrong account of the same class. Cash received from Malini credit to Malika's account. Error of complete reversal. This occurs when the correct amount is entered in the correct account but the entry has been made on wrong side of each account. Cash drawings debited to cash account and credited to the drawings account. Error of omission. This occurs when a transaction has been completely omitted from the accounting records. Neither a debit entry nor a credit entry has been made. Payment of wages not entered in the books. Error of origin and entry. This occurs when an incorrect figure is used when a transaction is first entered in the accounting records. The debit entry will therefore use the incorrect figure. Goods of $1,000 bought on credit but recorded as $1,000. Error of principal. This occurs when a transaction is entered using the correct amount on the correct side but in the wrong class of account. Motor expenses debited to the motor vehicle account. Compensating errors. These occur when two or more accounts errors cancel out each other. Purchases account added by $100 and sales return over added by $100. Recommended books for reference. Chapter 5, Part 1. Contents: a petty cash book, the interest system, advantages, the layout, format. The petty cash book or interest system. A petty cash book is used to record low value petty cash payments, include postage, stationery, cleaning, staff, expenses, small cash payments. Maintaining a petty cash book means it is not necessary to record small payments individually in either the cash book or the ledger. This reduces the number of entries in this book. The interest system. A petty cash book is used to record low value cash payment. The interest system of petty cash is where the amount spent each period is restored so that the petty cashier starts each period with the same amount. Advantages of interest system. The interest system, mostly petty cash books are maintained using the interest system. Under this system, the petty cashier starts each period week, fortnight, month, and with a fixed amount of money. This is known as interest amount or the float. During the period, payments are made out of the cash and are recorded in the petty cash book. At the end of the period, after the petty cash book is balanced, the chief cashier will forward the petty cashier with enough cash to restore the balance to the amount of interest flow. The petty cashier therefore starts each period with the same amount of cash. Under this system, the chief cashier is aware of exactly how much petty cash has been spent in each period. This means that the petty cash expenditure can be controlled. The amount of interest system can be adjusted as necessary if it is too much or not enough. The interest system can also help to reduce cost. The layout of petty cash book. The layout of petty cash book. A petty cash book resembles a ledger account with several many columns on the credit side. These are known as analysis columns and are used to divide the payment into different categories. A column is used for each of the main types of expense paid petty cash. Instead of folio column on the credit side, there is a column for recording the number of purchases to which the payment relates. The number of columns and the main types of expenses will be determined by each individual business. Format of petty cash book. So you can see the format. So dates, details, folio, total receipt, date, details, mutual number, total amount paid, analysis columns. So there are various expenses columns like convenience column. So this may be convenience column. This may be like small expenses, sundry expenses. This may be like for postage and telegram, small payments. Chapter 6, Part 1. In this lesson, we discuss about invoice, trade discount, cash discount versus trade discount, debit note, credit note, statement of account, checks or e-pay, receipt. Invoice. When a business sells goods on credit, will be issue an invoice to the purchaser. Each business has its own style of invoice, but they all contain the following information: the name and address of the supplier, the name and address of the customer, the date, full details, quantities, and prices of the goods supplied. Trade discount. Sometimes the supplier allows the customer trade discount. This is a reduction in the price of the goods. The rate of the discount often increases according to the quantity purchased, so encouraging customers to buy in bulk. It is also given to businesses in the same rate. Such businesses will not be prepared to pay the full rate as they need to make a profit when they sell the goods. Cash discount versus trade discount. It is important to distinguish between cash discount and trade discount. Trade discount is shown as a deduction on the invoice. Cash discount is not shown as a deduction from an invoice, as it is only allowed if the invoice is paid within a set time limit. Debit note. A debit note is a document issued by a purchaser of goods on credit to request a reduction in the invoice received. Credit note. A credit note is a document issued by a seller of goods on credit to notify of reduction in invoice previously issued. Statement of account. At the end of each month, a supplier will usually issue each customer with a statement of account. This is a summary of the transactions for the month. The style of a statement of account may vary, but they all contain the following information: the name and address of the supplier, the name and address of the customer, the date, the balance owing at the start of the period, invoices and credit notes issued, payment received, any cash discounts allowed, the balance owing at the end of the period. Checks or e-pay. Checks many accounts are paid by means of a check. Other methods of payment through the banking system are credit transfers and standing orders. The check is a written order to a bank to pay a stated sum of money to the person or business named in the order. A book of reprinted checks is issued by the bank, and the customer is only required to complete the necessary details of date,
amount and pay the person or business to whom the money is to be paid. The receipt. The receipt is a written acknowledgement of money received and acts as a proof of payment. Since a check passes through the banking system, it acts as a receipt. So many business. Chapter 7, Part 1. Contents. Books of prime entry. The books of prime entry is the list. Sales journal, sales return journal, purchase return journal. Books of prime entry. Businesses usually use books of prime entry to record goods sold on credit, goods purchased in credit, sales returns, and purchase returns. Books of prime entry, also known as books of original entry or subsidiary books. The name of these books has arisen because all transactions should be recorded in one of these books before they are entered in the ledger. Books of prime entry, the list. The books of prime entry are cash book, petty cash book, sales journal, purchase journal, sales return journal, purchase return journal, general journal. Sales journal. The sales journal is a list of the names of businesses to which credit sales were made. The value of the sales and dates on which sales were made. The sales journal is sometimes referred to as sales book or the sales journal. This journal is written up using copies of the invoices sent to the customer. The entries are summarized as follows. When goods are sold on credit, enter the date, customer name, and invoice total in the sales value. Debit the customer's account in the sales ledger with the invoice total. At the end of the month, credit the sales account in the nominal ledger with the sales journal total. This will now form the double entry for all individual debit entries in the sales ledger. Sales returns journal. The sales returns journal is a list of name of the businesses, the value of goods returned, and the goods on which the returns were made. The sales returns journal is also known as the sales returns book or the returns inward book or returns inward journal. This journal is written up using copies of the credit notes sent to the customer. The entries are summarized as follows. When goods are returned by a credit customer, enter the date, credit customer name, and credit note total in the sales journal. Create the customer's account in the sales ledger with the credit note total. At the end of the month, debit the sales return account in the nominal ledger with the sales return journal total. This will now form the double entry for all individual credit entries in the sales ledger. Purchase journal. The purchase journal is a list of names of businesses from which credit purchases were made. The value of the purchases and the dates on which purchases were made. The purchase journal is also called the purchase book or the purchases table. This journal is written up using the invoices received from suppliers. The entries are summarized as follows. When goods are purchased on credit, enter the date, supplier name, and invoice total in the purchases journal. Create the supplier's account in the purchases ledger with the invoice total. At the end of the month, debit the purchases account in the nominal ledger with the purchases total. This will now form the double entry for all individual credit entries in the purchases ledger. Purchase returns journal. The purchases returns journal is a list of names of businesses, the value of goods returned, and the date on which returns were made. The purchases returns journal is also known as purchases returns book or the returns outward book or returns outward journal. This journal is written up using credit note received from suppliers. The entries are summarized as follows. When goods are returned to a customer, credit supplier, enter the date, supplier name, and the credit note total in the purchases return journal. Debit the supplier's account in the purchases ledger with the credit note total. At the end of the month, create the purchase returns account in the nominal ledger with the purchases return journal total. This will now form the double entry for all individual debit entries in the purchases ledger. Chapter 8, Part 1. In this lesson, we'll discuss about an income statement, a statement of financial position, financial statement, trading section of income statement, cost of sales, net purchases, trading account format, profit and loss section of income statement, horizontal format versus vertical format, comprehensive income statement of service business. An income statement which consists of two sections. A trading section in which the gross profit of the business is calculated, a profit and loss section in which the profit for the year of the business is calculated. The trading section and the profit and loss section of the income statement are part of the double entry system. A statement of financial position. The statement of financial position shows the assets and liabilities of the business at a certain date. The statement of financial position is not part of the double entry system. Financial statements. An income statement and a statement of financial position are called financial statements. Financial statements are usually prepared from a trial balance. Every item in a trial balance appears once in a set of financial statements. Trading section of the income statement. The trading section is concerned with buying and selling, and its purpose is to calculate the profit earned on the goods sold. This is known as the gross profit. The formula for calculating gross profit is equal to selling price of the goods minus cost of sales. Cost of sales. The cost of sales represents the total cost of the goods actually sold. It is not necessarily the cost of goods purchased during the year. Some goods may have been in stock at the start of the year, and some of the goods purchased during the year may have been remain unsold at the end of the year. The formula for calculating cost of sales is equal to opening inventory plus net purchases minus closing inventory. Net purchases. The purchases figure represents the total cost of purchase less any purchase returns. If carriage income has been paid on goods purchased, this must be added to the purchases as it increases the cost of the goods. If the owner of the business has returned goods for personal use, the cost of these is credited to the purchases account. So reducing the cost of goods available for sale. If goods taken by the owner have not already been recorded, they must be deducted from the purchases. The formula for calculating the net purchase figure is net purchases is equal to purchases minus purchase returns plus carriage incomes minus cost of goods for own use. Trading account format. So this is the trading account format. So it should be presented in this actual way. The same way it should be presented line by line item. This is the pattern. This is the format. Profit and loss section of the income statement. The profit and loss section of income statement is concerned with profit and losses, gains and expenses. Its purpose is to calculate the final profit after all running expenses and other items of income. This is known as the profit for the year. The formula for calculating profit for the year is profit for the year is equal to gross profit plus other income minus expenses. Profit and loss section of the income statement. This is the format of profit and loss section. Horizontal format versus vertical format. As with the trading section of an income statement, profit and loss section can be prepared using either the horizontal or the vertical format. Using the horizontal format, the gross profit and any other income are shown on the credit side and the expenses are shown on the debit side. The difference between the two sides equals the profit for the year. If the credit side is the largest, or the loss for the year if the debit side is the largest. Comprehensive income statement. This is the format of comprehensive income statement. Wherein the gross profit, profit from operations, and net profit, everything can be shown. Income statement of a service business. A service business is one which does not buy and sell goods, such as an accountant, an insurance company, a travel agent, a hairdresser, and so on. As at the end of the financial year, this business still need to prepare financial statements. However, the trading and account section of the income statement is not prepared, as no goods are bought and sold. Only the profit and loss section of the income statement and the statement of financial position are prepared. In the income statement, all the items of revenue receivable, such as fees from clients, commission, and other income, are created and expenses are debited. The statement of financial position is exactly the same as the statement of financial position. Chapter 9, Part 1. Financial statements, Part B. Contents. A statement of financial positions, components of financial position, assets, tangible, non-current assets, intangible, non-current assets. Current assets, components of financial position, liabilities, capital, non-current liabilities, current liabilities. A statement of financial position. Statement of financial position shows the assets of a business, what the business owns and what is owing to the business, and the liabilities of a business, what the business owes on a certain date. The assets show how the resources are being used, and the liabilities show where they come from. Statement of financial position. So this is the format of statement of financial position. Assets, first you have to mention non-current assets, then you have to mention current assets, that will give total assets. Capital and liabilities, capital, non-current liabilities, current liabilities, total capital and liabilities. Components of financial statement assets. Assets are divided into two types. They are non-current assets. These are two types of non-current assets: tangible non-current assets, intangible non-current assets. Tangible non-current assets. Tangible non-current assets are long-term assets which are often for use rather than for resale. They help the business and revenue. Examples of tangible non-current assets include land and machinery, fixtures, and motors. In a statement of financial position, it is usual for the non-current assets to be arranged in increasing order of priority. This means that the most permanent assets are shown first. It typical order for showing tangible non-current assets in a statement of financial position is as follows: land and building, machinery, fixtures and equipment, intangible non-current assets. Intangible non-current assets are long-term assets which do not have material substance. They cannot be seen or touched. However, they belong to the business and do not have a value. Examples of intangible non-current assets include goodwill, brand names, and trademarks. In a statement of financial position, the intangible non-current assets are shown before the tangible non-current assets. Current assets. Current assets are those assets, short-term assets, because these arise from the normal trading activities of the business. Their amounts are constantly changing. These are assets which are either in the form of cash or which can be turned into cash relatively easily. Examples of current assets include inventory, trade receivables, bank, and cash. A statement of financial position is easier for the business assets to be arranged in increasing order of liquidity. This means that the assets further away from cash are shown first. A typical order for showing current assets in a statement of financial position is inventory, trade receivables, bank, cash. Components of financial statement liabilities. Liabilities are divided into three types. These are capital, non-current liabilities, current liabilities. Capital. Capital represents the owner's investment in the business and is the amount owed by the business to the owner. Non-current liabilities. Non-current liabilities are amounts owed by the business which are not due for repayment within next 12 months. Examples of non-current liabilities include long-term loan and mortgage. Current liabilities. Current liabilities are short-term liabilities. Since current liabilities, like current assets, arise from normal trading activities of the business. Their amounts are constantly changing. There are amounts owed by the business which are due for repayment within the next 12 months. Examples of current liabilities include trade payables and bank. Chapter 10, Part 1, Accounting Principles, Conventions and Assumptions. Contains accounting principles, business entity concept, consistency, duality, going concern, historical concept, matching principle, materiality concept, money measurement, prudence, realization, international accounting standards, comparability, relevance, reliability, understanding, capital expenditure, revenue expenditure, capital receipt, revenue receipt, inventory valuation. Accounting principles. Accounting principles are sometimes referred to as concepts and conventions. The concept is a rule which sets down how the financial activities of a business are applied. A convention is an acceptable method by which the rule is applied to a given situation. Business entity. The business entity principle is also known as the accounting entity principle, which means that the business is treated within the business. The personal assets of the owner, the personal spending of the owner, etc., do not appear in the accounting records of the business. The accounting records relate only to the business and record the assets of the business, the liabilities of the business, the money spent with the business, and so on. Everything is recorded from the viewpoint of the business. If there is transaction concerning both the business and its owner, then it is recorded in the accounting. When the owner introduces capital into the business, it is credited to the capital account. To show the funds coming from the owner, the capital account shows credit balance representing the amount owed by the business to the owner. When the owner makes drawings for the business, a double entry is made in the drawings to show the value going to the owner, which reduces the amount owed by the business to the owner. Consistency. There are some areas of accounting where choice of method is available. For example, there are several different ways to calculate the depreciation of non-current assets. If the choice of method is available, the one with the most realistic outcome should be available. Once a method has been selected, the method must be used consistently from one account period to another. This is known as the consistency principle. If this is not done, comparison of the financial results from one year to another is impossible and the cost of particular year can be discounted. There may be a good reason why it is necessary to change the method of valuation in such a situation. The change may be made, but the effects of this should be noted in the financial statements. Duality. The principle of duality is also referred to as the dual aspect principle. Every transaction has two aspects, a giving and a receiving. The term double entry is used to describe how these two aspects of a transaction are according to the accounting. Going concern. The accounting record of a business are always maintained on the business or assumed to continue. This means that it is assumed that the business will continue to operate for an indefinite period of time and that there is no intention to move the business by any significant amount. This is the going concern principle. This continuity means that the non-current assets shown in a statement of financial position will appear at their book level, which is the original costless depreciation. And inventory will appear at the lower of cost or net revenue level. If it is expected that the business will cease to operate in the near future, the assets following the statement of financial position of the business. Assets will be shown at their expected sales value, which are more meaningful than the value in this situation. Historic cost. The historic cost principle requires that all assets and expenses are initially recorded in the ledger accounts at their actual cost. This refers link to the money measurement principle. Cost is a known fact and can be defined. Applying this principle makes it difficult to make comparisons with transactions occurring at different times because of the effect of inflation. Sometimes it is necessary to adopt a more prudent approach to ensure that the non-current assets are shown as more realistic. So the cost price is reduced by depreciation. Matching. The matching principle is also referred to as the accrual principle. This is an extension of the realization principle to include both income and expenses. The revenue of accounting period is matched against the cost of the same period. The timing of actual receipts and payments. The figures shown in an income statement must relate to the period of the time covered by the statement, whether or not any money has changed. This means that a more meaningful comparison can be made of the profits, sales, expenses, and so on from the year. Materiality. The materiality principle applies to items of very low value. Items which are not material, which are not worth recording as separate accounts. Other principles can be ignored if the time and cost involved in recording such low value items for outweigh any benefit to be gained from this application of these principles. For example, a pocket calculator purchased for office is strictly a non-current asset. Part of its value being lost each year through non-current assets. The cost of calculating and recording this each year would amount to be more than the cost of the asset. Instead of the calculator being recorded as non-current asset, it will be regarded as an office expense in the year of purchase. What is material for one business may not be so for another business. The laptop computer may be regarded as material for a large multinational business, but would be material for a small sole trader. A large business may decide that non-current assets costing less than 1,000 will be regarded as material and we charge the expense. Small business may have a much lower value. This principle is also applied by entering small expenses on account, known as general expenses and expenses, rather than having individual line accounts. For office expenses like light bills, flower displays, and so on. Materiality is also applied in relation to increase of office supplies and other items. When the total cost of another structure is treated, there are some left in there. Money measurement. The money measurement principle means that the only information which can be expressed in terms of money can be recorded. Money is a recognized value of money and is a traditional way of valuing transaction. It does not rely on personal opinions and its action. There are many aspects of a business which cannot be measured in terms of money and therefore do not appear in the account. The moral of purpose, the effectiveness of good managers, the benefits of stock trading process all play an important part in success of that, but they will not appear in the accounting record as the value cannot be expressed. In a similar way, laws of private product or increased competition cannot be recorded in the accounting year, as their effects cannot be measured in monetary terms. Prudence. The prudence principle is also known as the principle of conservatism. This principle ensures that the accounting records present a realistic picture of the position of the money. However, the excesses of prudence does not allow the deliberate understatement of assets and income, or the deliberate overstatement of liabilities or expenses. In short, prudence does not permit bias. Accountants should ensure that the profits and assets are not overstated and the liabilities are not understated. The phrase never anticipated profit will not for all profit and assets is often used to discuss the principle of prudence. Profit should only be recognized when it is reasonable certain that the profit has been realized and all possible losses should be provided for. Prudence is a very important principle. If a situation arises where applying another accounting principle is contrary to the principle of prudence, then the principle of prudence is applied. For example, under the realization principle, profit is earned when goods actually change. If the customer fails to pay after a reasonable time, the principle of prudence may be applied and the debt is returned. Realization. Realization principle emphasizes the importance of not recording the profit until it has been achieved. This means that revenue is only recorded as earned when the legal title or services passed or has been an obligation liability to pay for it. When an order is placed by a customer, no goods change hands and no profit is earned. Profit is regarded as being realized when the goods actually change hands. This is the same even if the goods are no longer and the customer does not pay for them immediately. International accounting standards. International accounting standards ensure that financial statements are prepared using the same rules and rules internationally. Knowledge of the individual accounting standards is relevant for endowments. The objective of the standards are to ensure that the users of financial statements are protected and not misled. The quality of information contained in financial statements depends on these standards. This quality of information can be measured in terms of four factors: comparability, relevance, reliability, and understandability. Comparability. The information contained in financial statements are useful if it can be compared with similar information or at another point in time. It is also useful to be able to compare the information with similar information. In order to make comparisons, it is necessary to be aware of any different policies. Any changes in these policies and the effects of such changes, it is important to be able to identify similarities and differences in the financial statement and the information relating to other account students or other businesses. Relevance. Financial statements provide information about the business financial performance information. This can be used as the basis for financial decisions. It is important that the information is provided in time for these decisions. Information not available when required is of use. It is also important that the information is relevant to users of financial statements. This means that it can be used to confirm or verify the expectations of the past and also to help forming, revising, or confirming expectations. Reliability. Information provided in financial statements can be reliable if it is capable of being depended upon by users of being included representation of underlying transactions which it is represented. Capable of being independently verified free from bias, preference, and others, prepared with suitable caution being applied to any judgments and estimates which are necessary. Understandability. It is important that financial statements can be understood by the users of these statements. This depends partly on the clarity of the information provided, also depends on the abilities of the users of financial statements. It is normally assumed that users of financial statements are reasonably knowledgeable of business and economic activities and accounting, and that they will be reasonably diligent in studying the financial statements. However, information should not be omitted from the financial statements because it is decided that it is too difficult for users to understand. Capital expenditure. Capital expenditure is money spent by users on purchasing non-current assets. Non-current assets. This includes all the legal costs incurred in the purchase of non-current assets. Cost of carriage period of non-current assets and cost of non-current assets. These costs will appear in non-current assets in the statement of financial position. They should not be charged as expense in the year of purchase to benefit the business facilities. The value of non-current assets often decreases because of depreciation. This cost will be managed against the annual revenue in the current assets. Help the business to revenue expenditure is money spent on running a business on day-to-day. This includes the investment and the cost of maintaining and running the non-current assets. It also includes the cost of purchase for the purpose of research. These costs will appear in the income statement. They are not in the revenue. If these two types of expenditures are treated correctly, the profit for the year will be included in the statement of financial. This fiscal balancing will also be included. For example, if you request the machine or treated as an improvement to the machine, the expenses will come statement to be invested. So the profit for the year will be restricted. In the statement of financial position, the non-current assets will be restricted, and the capital also will be restricted. So the correct profit. Capital receipt. The capital receipt occurs when money is received from normal trading activity. This includes the receipt of capital from the owner, the receipt of loans and proceeds of sale of the non-current asset. Capital expenditure is money spent on purchasing non-current assets. Revenue expenditure is money spent on running a business on that basis. The capital receipt is money received by business from a source other than the normal trading activities. The capital receipt should not be incurred in the if however a profit or loss is made on the sale of non-current assets, included in the revenue receipts. The revenue receipt is money received by business from normal trading activity. This includes revenue from the sale of goods, space, plants, and other income, such as rent receipt, commissions, discount receipt, and so on. Because these arise from the normal trading activities, they are incurred in that. Inventory valuation. Inventory valuation is necessary to value its inventory of each financial year. Inventory is always valued as the cost of net reserve value. This is simply application of principle of overrunning the inventory by both the profit and access to the cost of inventory is actual purchase price plus any additional cost is carried in correct. The net realizable value is estimated receipt instead of the inventory, less any cost of completing the goods or cost of selling the goods. Usually the cost of inventory is lower than the net realizable value. It may happen that the goods are damaged or there is no demand for the good because of change in taste of fashion. In this situation, the net realizable value is more than cost. Chapter 11, Part 1, Other Payables and Receivables. Other payables and receivables. In this lesson, we are going to discuss year-end adjustments, practical applications of matching principle, accrued expense, combined expense on accrued income, prepaid income, opening balance on income. Year adjustments. It is often necessary to make adjustments to the accounting records in order to present a more accurate view of profit and loss of the business and the financial position of the business. Such adjustments are referred to as year-end adjustments. It is common to find expenses or income unpaid, or to find expenses or income paid in one financial year, but which relate to other financial years. Only items relating to that particular time period should be included in the statement. Thus, timing of actual receipts and payments is not available. An income statement is prepared for a different period of time. The period of time covered by the statement is purposes. Practical application of the matching principle. This is a practical application of matching principle. It is necessary to adjust the items within income statement for amounts prepared or accrued. This means that the profit or loss will be shown at a more accurate year, and it allows for more meaningful comparisons of financial statements from year to year. The use of simple diagram is often useful when calculating the expense or income relating to the particular financial year. This is illustrated in the examples used in this chapter. Accrued expenses. Accrued expenses in accrual is an amount due in an accounting period which remains unpaid at the end of the accounting period. When an expense is accrued, it means that some benefit or service has been received during the accounting period, but this benefit or service has not been paid for to the end of the period. To apply this matching principle, the amount transferred to the income statement should represent the expense for the accounting period covered by the account. This means that any amount due but unpaid at the end of the financial year must be added to the amount paid, and the total expense relating to the accounting will transfer to the income statement. The expense account will now show a balance equal to the amount unpaid. To complete the double entry, this balance is brought down on the page ledger account, as the balance represents an amount owing due to payment in the it will be included as current liability in the statement of prepaid expenses. A prepayment is an amount that is paid in advance, and expense is prepaid. It means that a payment is made during the financial year for some benefit or service. As with accrued expenses, the matching principle measures as well as the amount transferred to the income statement represent the expense. Any amount paid during the financial year relating to the accounting period expense relating to accounting period is transferred to the income. The expense account will now show a balance equal to the amount paid in advance. To complete the double entry, this balance is brought down on the as the balance represents the business is paid for but which is not used. To be included as current expense. Opening balance on expense. The total is a first year of business, another expense and opening balance. There might always be a closing balance in the opening balance. This must be considered when calculating expense rate. Combined expense account. Sometimes users can use one ledger account for two different related expenses. The same principle are applied as those used for the account containing expenses. The only difference is that there may be two opening and closing. Accrued income. Where an item of income is accrued, it means that another person receiving benefit or service from the person during the year not paid for the benefit. The total of income account in the year are transferred to the income statement. The matching principle is applied to income in the same way as it is expenses to the account are transferred to the income statement representing the income for the account. This means that any income due but not received. total income relating to the account will transfer to the income account will now show a balance in the amount compared to double entry. This balance is not as the balance represents an amount in the received and included as prepaid income. An item of income is prepaid, meaning that a person is paid for a benefit of once again, the matching principle must be applied so that the amount transferred to the income statement represents the income of the state. Any amount received during the financial year relating to the previous year must be deducted from the amount received so that only the income relating to the amount accounting period is transferred to the income. The income account will now show a balance equal to the amount received in advance. Complete the double entry. This balance is not known on the credit side. This balance is included as the business has a liability cost. Opening balances are income accounts. The scheme and subsequent years of trading a business opening balances. These must be considered when calculating income relating to the financial year for which the accounts. Accounting for depreciation, chapter 12, part 1. Depreciation. So in this lesson, we are going to learn about depreciation, the whole concepts of depreciation, methods of calculating depreciation, straight line method, advantages and disadvantages, reducing balance method, revaluation method of depreciation, recording depreciation in the ledger, accounting depreciation in income statements, accounting depreciation in position statement, depreciation manufacturing accounts, the net book value, depreciation appears twice, disposal of non-current assets. Depreciation. Depreciation is an estimate of the loss and value of the non-current asset over its expected working life. Most of the non-current assets of the business lose value over a period of time that are used by the business. If the accounting records continue to show these assets at their cost prices, then the accounts will provide misleading information. It is therefore necessary to record an estimate of the loss in value. The records can only show an estimate of the loss in value of the non-current asset because of depreciation. The exact amount will only be known when the asset is disposed or sold. Buildings depreciate over time, but land does not usually lose value unless it is something like a well or mine when value is removed from the land. The whole concept of depreciation. The purchase of non-current asset is capital expenditure. The cost of non-current asset is not charged as expense in the year of purchase. It is benefits the benefit business for several years. Matching the capital expenditure against the sales it has helped the business to earn is done by annual charge for depreciation. This means that the cost of non-current asset is spread over the years, which benefit from the use of that asset. The depreciation for the year is included in income expenses in the income statement. So the profit for the year is not overstated. This is an application of the principle of prudence. If the profit is overstated, the owner of the business may be tempted to withdraw more cash than the business can actually afford. The principle of prudence is also applied in the statement of financial position as the non-current assets are recorded at a figure less than the cost price. This is known as the book value or the returned on value. This overrides the historic cost principle as it ensures that the non-current assets are shown at more realistic values. Causes of depreciation. The four main causes of depreciation are physical deterioration, economic reasons, passage of time and depletion, physical deterioration. This is the result of wear and tear due to the normal usage of the non-current asset. It can also be because the asset falls into poor physical state but due to rust, rot, decay and so on. Economic reasons. The non-current asset may become inadequate as it can no longer meet the needs of the business. It can also be because the non-current asset has become obsolete as newer and more efficient assets are now available. Passage of time. This arises when where a non-current asset, for example, the lease has fixed life of a set number of years. Depletion. This arises in connection with non-current assets such as wells and mines. The worth of the asset reduces the value is taken from the asset. Methods of calculating depreciation. There are several methods used to calculate the estimated loss in value of non-current assets. Different types of non-current assets are often depreciated using different methods. The method selected should be the one which spreads the cost of the asset as fairly as possible over a period with benefit from its. Once a method has been selected for a particular non-current asset, it should be applied each year. This is an application of the principle of consistency. In practice, Many factors are considered before a depreciation method is selected. These are: how long is the asset expected to last, how much will the asset be sold for when it is put out of use, how can the benefits from the use of the assets be measured. These are the three main reasons for depreciation: straight line method, reducing balance method, revaluation method. Straight line method of depreciation is also known as fixed installment method or original cost method. The formula used for calculating the annual depreciation using this method is cost of asset over number of expected years of use. This expresses the annual depreciation as an amount of money. The answer to this formula expressed as a percentage of total cost. This method applies the same amount of depreciation or the same percentage rate of the cost by each year. The value of the asset can fall to nil if there is no residual value. This method is used where each year is expected to benefit equally from the use of the asset. Advantages and disadvantages. Advantages of the straight line method of depreciation. It is relatively easy to calculate. It is useful when a non-current asset provides equal benefit for each year of its useful life. Disadvantage of straight line method of depreciation. It is necessary to estimate the useful life and the residual value of non-current asset. It ignores the actual rate at which the non-current asset will lose value. Reducing balance method. Reducing balance method of depreciation. When name implies the amount of depreciation reduces each year. The same percentage rate is applied, but it is calculated on a different value each year. At the end of the first year, the depreciation for that year is calculated on the cost of the asset. The depreciation of the following year is calculated on the cost of the asset plus the depreciation previously written off. The figure of cost plus depreciation is known as the net book value or return on value of the asset. The value of the asset can never fall to nil as the depreciation always calculated as a percentage of net book value. This method is used when the greater benefit from the use of assets will be gained in the earlier years of life. Assets depreciated by this method often have low maintenance costs in the early years. This method is often used for those assets which quickly become out of date because of advancing technological progress. Any residual value is taken into the consideration when the percentage rate is selected. Advantages and disadvantages. Advantages of the reducing balance method of depreciation. Matches cost with revenue. It is useful for those non-current assets where greater benefits are gained in the early years of usage. Disadvantages of the reducing balance method of depreciation. The depreciation has to be recalculated each year. The depreciation charge against profit is greater in the early years of non-current assets. Revaluation method of depreciation. This method is used where it is not practical or it is difficult to keep detailed records of working types of non-current assets. If detailed records are not available, then the straight line method and reducing method of depreciation cannot be calculated. Small items of equipment used in offices and laboratories, packing cases, loose spools, etc. are usually depreciated using the revaluation method, as no detailed records are kept for these assets. The assets are valued at the end of each financial year. This value is compared with the value at the end of previous financial year or with the cost of if it is the first year of ownership. The amount by which the value of the asset has fallen is the depreciation for the year. Advantages and disadvantages. Advantages of the revaluation method of depreciation. It is not necessary to estimate the useful life and residual value of the current asset. No complex calculations are required. Disadvantages of revaluation method of depreciation. The non-current asset has to be revalued at the end of each year. The valuation is based on personal opinion. Recording depreciation in the ledger. Recording depreciation using the straight line method and reducing balance method. The procedure for entering depreciation calculated using straight line method and reducing balance method is exactly the same. Each year of non-current asset has two ledger accounts: an account for recording the cost of the depreciation, account for recording the depreciation, the provision for depreciation of asset account. The asset account always has a debit balance and the provision for depreciation always has a credit balance. These two balances must always be considered together. The difference between the balances of these accounts represents the net book value of the asset. Recording depreciation in the financial statements. Recording depreciation in the income statement. The depreciation for the year for which each type of asset is credited to provision for depreciation is normal and is debited to the income statement. This reduces the business profit for the year. As depreciation is non-monetary expense, it is usually shown after the monetary expenses in the income statement. Depreciation in manufacturing business. So the business is a manufacturing business. Depreciation of using the manufacturing process will be debited to manufacturing account rather than the income statement. This increases the cost of manufacturing, which in turn reduces the profit for the year. Reducing recording depreciation in the statement of financial position. It is usual to show the total cost of each type of non-current asset less the total depreciation return up to the date of statement of financial position, referred to as accumulated depreciation or depreciation to date. The difference between these figures is the net book value. Depreciation appears twice. The financial statements are prepared from a trial balance and its accompanying notes. In the trial balance, the balances on assets account are shown on the debit column and the balances in provision are shown in the credit column. One of the notes will indicate the depreciation to be charged financial year. The depreciation for the year will appear twice in the financial statement. It is an expense in the income statement, and it is included in the statement of financial position, a part of the provision for depreciation. The depreciation for the year is added to the balance shown in the trial balance. Disposal of non-current assets. Because the purchase of non-current asset is capital expenditure, it is recorded in an account for the current asset rather than a purchase account. When a non-current asset is sold, it is capital asset and is recorded in a special account known as the disposal of non-current asset account rather than in the sales account. When a non-current asset is sold or disposed, it must be removed from the ledger account. The cost of the asset and the depreciation of the asset are removed from the asset account, and the provision for depreciation account transferred to the disposal account. The proceeds of sale are also entered in this account. It is quite likely this account will not balance. This is because the depreciation was only an estimate on the loss of the loss in value. Only when the asset is sold can the residual actual loss in value be calculated. The difference on the disposal account represents whether a loss on disposal when the actual depreciation proved to be more than the estimate, or a profit in disposal when the actual depreciation proved to be less than the estimate. Chapter 13, Part 1, Irrecoverable Debts and Provision. In this chapter, we discuss irrecoverable debts, writing off, recovery of bad debts, written off, year-end adjustment, irrecoverable debts versus provision for irrecoverable debts, estimation, creating, adjusting a provision for irrecoverable debts. Irrecoverable debt. When goods are sold on credit, the customer is allowed to pay for the goods at a later date. There is always a risk that the customer may not pay for those goods. An irrecoverable debt is an amount owing to a business which will not be paid to the credit customer. This may be because the customer has disappeared, has gone out of business, or because he is unable to pay. If all reasonable steps to obtain payment have failed, the debt is written off. The account of customer is closed by transferring the amount written off to the irrecoverable debts account. At the end of the year, the total of the irrecoverable debts account is transferred to the income statement, where it is regarded as an expense for the year. Writing off. Writing off irrecoverable debts is an example of the application of the principle of prudence. If a debt cannot be regarded as an asset, it is written off so that the assets are not overstated. The amount of the irrecoverable debt is regarded as a loss for the year, so must be included in the income statement. Otherwise, the profit for the year will be overstated. Recovery debts written off. Written off may be recovered if his customer pays some or all of the amount after the amount has been written off. As the account of the customer has been closed, the amount received is debited in the cash book and credited to a debts recovered account. An alternative method is to reinstate the debt by creating the debts recovered account and debiting the customer with the amount they previously written off. The amount received would then be entered in by debiting the cash book and crediting the customer. The advantage of this method is that all the transactions relating to the customer appear in their account. Year-end adjustment. At the end of the year, the total of the debts recovered account can either be transferred to the income statement as income for the year or transferred to the credit of the irrecoverable debts account, where it reduces the debts written off during the year. Reducing the possibility of irrecoverable debts. The only certain way of avoiding irrecoverable debts is not to sell goods on credit. In practice, this is not always an option. All possible steps may be taken to avoid irrecoverable debts. Before allowing credit to any customer, credit preferences should be obtained. One from a customer's bank and one from present of use together. A credit limit is usually fixed for each customer. This is an upper limit on the amount of customer can move at any one time. This credit limit can be reviewed periodically. The establishing of credit limit and the later monitoring of the customer's account is known as credit limit. Invoices and monthly statements account should be issued promptly. The sales ledger account should be carefully monitored. Any overdue account should be investigated and the customers contacted by letters, emails, and telephone calls if necessary. No further goods should be supplied until the amount due is paid. A more extreme measure involves taking legal action against the customer, but sometimes the amount of debt is too small to justify costly legal proceedings. Provision for doubtful debts. A provision for doubtful debts is an estimate of the amount which the business will lose in a financial year because of the doubtful debts. At the end of their financial year, many businesses try to anticipate the amount which will be lost because of irrecoverable debts. This ensures that the profit for the year is not overstated. The amount of credit receivers in the statement of financial position is shown at a realistic level. This is an application of the principle of prudence. By maintaining a provision for doubtful debts, the business also observes the principle of financial. The amount of sales for the business is unlikely to be paid is regarded the expense of the year in which those sales are made rather than the expense of the year in which debt is actually incurred. Estimation. In order to make a provision for doubtful debts, it is necessary to estimate the amount of doubtful debts. The amount of provision is established by looking at each individual credit customer's account, estimating which one will not be paid. Estimating on the basis of past experience the percentage of total amount owing the calculation will not be paid. Considering the length of time debts have been outstanding by means of an aging schedule, a provision of a higher percentage may be made on older debt. The longer a debt is outstanding, the greater the risk is now becoming. Creating a provision for doubtful debts. Once it is decided to create a provision for doubtful debts and the amount of percentage has been decided, this can be recorded in the books. These entries are made at the end of the financial year. The entries are summarized as follows. Debit the income statement in credit of provision for doubtful debts. In the statement of financial position, deduct the balances on the provision for doubtful debts and account for the trade receipts. Adjusting a provision for doubtful debts. In future years, it may be decided to maintain the provision of doubtful debts using the same percentage on the trade receipts. If the amount owing has increased, the provision need to increase and vice versa. If the original provision for doubtful debt was based on the amount of money rather than percentage, may be decided the sum will change. This adjustment for the provision of doubtful debt is made at the end of the financial year. The entries are summarized as follows. Debit the provision for doubtful debts account with the new provision and carried on as the credit balance. Transfer the difference of the provision for doubtful debts account to the income statement. In the statement of financial position, deduct the balance on provision for doubtful debts account, the new provision from trade receipts. Chapter 15, Part 1, all journal entries. In this chapter, we discuss about the opening journal entries, purchase and sale of non-current assets, non-regular transactions, correction of errors which affect the trial balance, suspense account entries, effect of errors on financial statements. The journal is a book of prime entry used to record transactions which will not be recorded in any other book of prime. The journal is not part of double entry bookkeeping. It is regarded as a diary in which transactions are noted before they are entered in ledger. Anything which is not entered in any one of the books of prime entry must be entered in the journal before being recorded in the ledger. Opening journal entries. As the name suggests, opening journal entries are made when the business starts or when the business first keeps accounting records. An opening journal entry lists the assets owned by the business shown in the debits column, the liabilities owed by the business shown in the credit column, and the capital of the business also shown in the credit column. After the journal entry has been prepared, the items are posted to the appropriate ledger. Purchase and sale of non-current assets. As the purchase and sale of non-current assets are not recorded in nor the other books of the company, they should be entered in the journal proper before being posted to the ledger. After the journal entry has been completed, the transaction is posted to the appropriate ledger. Non-regular transactions. As explained earlier, any transaction which cannot be recorded in a book of entry are recorded in it. These often consist of transactions which are not recurring regularly and year-end transfers to the income statement. The transaction is posted to the appropriate ledger accounts after the journal entry. Correction of errors. Errors made in the recording of day-to-day transactions can be divided into those which are not visible to the trial balance and those which result in the trial balance. Errors which are not shown with the trial balance. These are 8 types of errors. 6 types of errors which can be made by which may not be revealed to the trial balance. They are error of commission, error of complete reversal, error of entry, error of principal compounding errors. When such errors are discovered, they should be discussed by means of an entry before making entries in the appropriate ledger. Error which affect the trial balance. Some errors may affect the trial results in the total of the trial balance non-balance. If the errors are not found immediately, the trial balance is balanced by inserting the difference between the two sides in the distance. This is regarded as a temporary account in which the differences on the trial balance is held until the errors are discovered. The suspense account. A suspense account ensures the balancing of trial balance and loss draft financial statements to be prepared. It also allows errors to be corrected by using double entry and ensures that all errors are found. Closing suspense account. As the errors are found, they are corrected by means of journal entry. The appropriate entries are then made in the ledger accounts. When all the errors have been found and corrected, the suspense account will close automatically. Balancing suspense account. If all the errors affecting that balancing of the trial balance are discovered and corrected, the suspense account will automatically close. The balance remaining on the suspense account indicates that there are still some errors in the account. Effect on profit of correcting errors. If errors are discovered after the income statement has been prepared, it is necessary to amend the profit. Any corrections made by items appearing in the trading section of the income statement affect both the gross profit and the profit for the year. Any corrections made to items appearing in the profit and loss section of the income statement will affect the profit for the year. Effect on statement of financial position of correcting errors. If errors are discovered and corrected after the preparation of financial statement, the statement of financial position may not be amended. If the profit for the year has been corrected, this will affect the capital statement. Whether items may also need to be amended. Chapter 16, Part 1, Control Accounts. Control accounts. In this chapter, we will discuss all about control accounts, that is the meaning, sales ledger, control account, purchase ledger, control account, items excluded, contents of control accounts, format, sources of preparing control accounts, items included and excluded from control accounts, dual balances. Control accounts. Control accounts are also known as total accounts. If the trial balance fails to balance and the error cannot be readily located, it is necessary to check all the accounting files. This can take a considerable amount of time. The checking process can be speeded up if a control account for sales ledger which contains the accounts of the debtors and a total control account for the purchases ledgers which contain the accounts of the creditors have been prepared. These accounts act as a check on the individual accounts within these ledgers. Like the trial balance, however, these accounts can only check the arithmetical accuracy. Errors such as omission and commission will not be revealed by a control account. Sales ledger control account. The sales ledger control account is an account summarizing all the accounts of the trade receivables. Purchase ledger control account. The purchase ledger control account is an account summarizing all the accounts of trade payables. Advantages of control accounts. Where a full set of accounting records is maintained, it is easier to prepare a sales ledger control account and a purchase ledger control account. The advantages of preparing these accounts are as follows. They can assist in locating errors when the trial balance is balanced. They are proof the arithmetical accuracy ledgers they control. The balances on these accounts are regarded as being equal to the total of the trade receivables and the total of the trade payables. So this information is available immediately. Draft financial statements can be prepared quickly because the balances provided by the control accounts. They have to reduce fraud as the control accounts are prepared by someone who has not been involved in making the entries in these particular ledgers. They provide a summary of the transactions affecting the trade receivables and the trade payables for each financial year. Excluded items. The sales ledger account is a summary of the accounts of credit customers, trade receivables, and so will not include items which do not appear in the account of credit customers, such as cash sales and provision for debt credits. Sales ledger control account content. Sales ledger control account. This is also referred to as a total trade receivables account. This account resembles the account of a trade customer, credit customer, but instead of containing transactions concerning just one person or business, it contains transactions relating to all the debtors. A typical sales ledger control account is shown here. Sales ledger control account format. So on the debit side, you can see the balance is there, the sales, bank for the sum and check, bank or check refunds, receipt, interest charge. So on the credit side, sales returns, cash, discount allowed, vehicle debts. This account acts as a check on the individual customer's account. It should be prepared independently and information on individual account of customers. Another in the sales ledger will not be revealed if the control account is prepared from the accounts in the table. The information to prepare a sales ledger control account is obtained from the parameters. The sources of information are summarized as follows. Source of information. For sales, it is sales channel. Sales returns, it is sales income channel. Receipt from credit customers, discount allowed to credit customers, dishonored shares, difference to credit customers can be obtained from that. Irregular debts written off, interest charge and overdue accounts can be obtained from channel. The sales channel ledger control account is drawn up at the end of financial period after month end. The total of the balances on all the individual credit customers accounts should agree with the balance in the control account. If they are different, it indicates that there is an error in one of the customers' account or an error in the control account. So further checks are required. Purchase ledger control account. Purchase ledger control account is also known as the total trade payables account. This account resembles the account of trade supplier, but instead of containing transactions concerned with just one person or business, contains transactions relating to all the employees. Typical purchase ledger control account is shown. So this is the format of purchase ledger control account. So you can see Purchase returns on the debit side, cash, bank discount receipt on the debit side. On the credit side, it's balance brought down, purchases, interest charge, so all this. So the accounts are similar purpose to the sales ledger control and actually check on the individual credit suppliers account and also prepare independent non-form information and individual accounts of credit suppliers. The information to prepare a purchase ledger account is obtained from the book of revenue. The source of information are summarized as follows. Purchases are obtained from purchase journal, purchase returns from purchase journal, payment to credit suppliers, discount receipt from credit suppliers, and treatment from credit suppliers in type. Interest charge on overdue accounts from journal, like the sales ledger control account, the purchase ledger control account is drawn up at the end of the financial period, often monthly and balance. The total of the balances on all the individual credit suppliers should agree with the balances in the control account. If they differ, it indicates that there is an error in one of the suppliers account or the control account, so further checks are required. What is not used? The account in the sales and purchase ledger are not used to provide information for the control account. Otherwise, errors in the ledger will not be removed. What is included in this? The sales ledger account is a summary of accounts of credit customers. Trade receivables will not include items which do not appear in the account of credit customer, such as cash sales and provision for debt products. So, purchase ledger account is a summary of the accounts of credit suppliers. Trade payments will not include items which do not appear in the accounts of credit suppliers, such as cash purchases. Balances on both sides. Occasionally, a credit customer's account may show a credit balance. This may occur due to an overpayment to the customer returning goods after paying the account, the customer paying in advance for the goods, cash discount not being deducted before paying those money. In the sales ledger control, it is usual to keep any credit balances separate from the debit balance. The control account will therefore have two balances: the usual debit balance representing money owed to credit customers, and the more unusual credit balance representing money owing to credit customers. Any credit balance is entered on the debit side control account carried down as a credit balance. That account can then be balanced in anything. Balances on both sides. In a similar way, credit supplier's account can share a debit balance. This may occur due to an overpayment to the supplier, returning goods to the supplier after paying the account, paying the outlay advance for the cash discount not being deducted before payment. As in the sales ledger control account, the debit balance and the credit balances are shown separately in the purchase ledger control account. The purchase ledger control account will therefore have two balances: the usual credit balance representing money to credit suppliers and no usual debit balance representing money by credit suppliers. Any debit balance is entered on the credit side of the control account and carried down as a debit balance. The account can then be balanced in the usual. Contra entries. Contra entries in control accounts. Contra entries are also known as interledger transfers or set-offs. It may happen that a business sells goods to another business and also buy different goods from the business. This means that there will be two ledger accounts for that business, one in the sales ledger and other in the purchase ledger. Rather than each business sending the other a check to cover the amount, then agree to set one account of against the other. Any remaining amount will be settled by one business issuing a check. Transfers and set-offs. Contra entries may be referred to as interledger transfers or set-offs under when a transfer is made from an account in the sales ledger to an account of the same business or person in the purchase ledger. Chapter 17, Incomplete Records. In this chapter, we discuss incomplete records, advantages of double entry records, statement of affairs, formula to find profit, cash discount in incomplete records, markup, margin and inventory turnover, weight of inventory turnover. Incomplete records. Sometimes businesses, small businesses in particular, do not maintain a receipt of complete records. This means that return balance cannot be drawn up and financial statement cannot be prepared until a certain amount of preparatory calculations have been carried out. Much depends on the records and information available as to whether a full set of financial statements can be prepared. Advantages of maintaining double entry records. Maintaining a full set of double entry record is important for its management. This includes the following. Full details are available about the assets, liabilities, revenues, and expenses of the business. The preparation of financial statement is relatively straightforward. The calculation of the profit or loss for the year is likely to be reliable and accurate. More informed decision making is possible. A greater degree of control over business activities can be exercised. The possibility of fraud is reduced. Comparisons with the results of previous year and with business are possible. Detailed records are available for reference purposes. Information required by a bank or other lender is readily available. Statement of affairs. If the only records available are those relating to the assets and liabilities of the business, it is not possible to prepare an income statement. These assets and liabilities are listed in a statement of affairs, which is similar to statement of financial position. When a list of assets and liabilities is prepared without the use of set of double entry records, it is known as a statement of affairs rather than a statement of financial position. Formula: if the assets, liabilities, and capital of business are known and no other information is available, the only way in which the profit can be measured is to compare the changes in the capital over the financial period. Capital increases when a profit is made and decreases when a loss is incurred. The basic formula for calculating profit is closing capital minus opening capital equals profit. What are the difference between the two capital figures when we call the drawings and the one? If the drawings are taken place during the period, the formula is modified to closing capital minus opening plus drawings is profit. In additional capital, if additional capital has been introduced during the period, this will also account for some of the difference between the two capital figures. The formula is modified to closing capital minus opening capital plus drawings minus capital introduced is equal to profit. Cash discount. Cash discount allowed and received must be included in the calculations of rate sales and rate purchases. The discounts must also be recorded in the profit and loss section of the income statement. Markup, margin, and inventory turn. When dealing with income get record, it is sometimes necessary to use percentages to calculate the same information. Markup and margin. These both measure the gross profit as a percentage. The markup is the gross profit measured as a percentage of the cost price. The margin is the gross profit measured as a percentage of selling price. Rate of inventory turnover. It is sometimes necessary to use calculations relating to rate of inventory turnover in order to calculate an unknown figure in the trading account section of the income statement. The rate of inventory turnover is the number of times a business replaces its inventory in a given period of time. The formula for calculating the rate of inventory turnover is cost of sales upon average inventory. Chapter 18, Part 1, Accounts of Clubs and Societies. In this chapter, we discuss NPO, non-profit organizations, receipts and payments account, nature of receipts and payments account, income statement, surplus or deficit, income and expenditure account, accumulated funds, subscriptions, not-for-profit organizations. This chapter concentrates on the accounts of non-trading organizations such as clubs and societies. The main aim of these organizations is to provide some facilities and services for their members. Making a profit is not the main objective. Examples of such organizations include youth clubs, sports clubs, amateur dramatic groups, golf clubs, scouts, etc. In some cases, a full set of double entry records is written up each year, but it is more usual to find that only a record of money received and paid is maintained. The main source of income of society is subscription. These are the amounts members pay, usually annually, to use the facilities provided by the club or society. A person is appointed to act as treasurer and be responsible for collecting any money due to the society and for paying money owed by the society. At the end of the financial year, the treasurer will usually present financial statements to the members. These financial statements may consist of receipts and payments account, possibly a trading account section of an income statement, an income and expenditure account, and a statement of financial position. Preparation of a receipts and payments account. A receipts and payments account is regarded as summary of the cash book for the financial year. Our money received is debited and our money paid is credited. The account is balanced and the balance carried down to become the opening balance for the financial year. The account does not usually distinguish between cash and bank transactions, so the balance may represent actual cash, money in the bank, or combination of the two. A debit balance is an asset and represents money owned by the society, whereas a credit balance is a liability and represents a bank overdraft. A receipt and payment account, just like a cash book, records all money received and paid. It is important to remember that no adjustments are made for accruals and prepayments. No distinction is made between capital receipts and revenue receipts. No distinction is made between capital expenditure and revenue expenditure. Non-monetary items such as depreciation are not included. A real account. A receipts and payments account includes all money paid and received, including the year to which it relates, and includes both capital and revenue items. Preparation of income statement of a club or society. Although buying and selling is not the main purpose of club or society, many do carry out the trading activity. Many clubs operate a shop or a cafe where goods are bought and sold. At the end of the financial year, income statement trading section only should be prepared for each separate trading activity to show the profit earned on that activity. The trading section of an income statement of a club or society is prepared in exactly the same way as that for businesses. Any expenses which arise as a result of running the trading activity, such as wages of cafe assistants, depreciation of cafe equipment, and so on, should be added to the cost of the goods sold in order to calculate the correct profit and loss. Surplus of deficit. An income and expenditure account is prepared annually by a non-trading organization and compares the gains and expenses to calculate the surplus of deficit. The surplus arises when the gains of a non-trading organization exceed the expenses. The deficit arises when the expenses of a non-trading organization exceed the gains. Preparation of an income and expenditure account. An income and expenditure account compares the gains of the club with the expenses of running the club. If the gains are more than the expenses, the difference is referred to as the surplus or excess of income or expenditure. This is known as the profit for the year in business. If the gains are less than the expenses, the difference is referred to as deficit or excess of expenditure or income. This is known as the loss for the year in business. An income and expenditure account is prepared using the same principle as those applied in the preparation of an income statement of a trading business. It is important to remember that adjustments must be made for accruals and prepayments. Capital receipts and capital expenditure also are not included. Only revenue receipts and revenue expenditure are included. Non-monetary items such as depreciation are included. Assets and liabilities at the beginning and at the end of the financial year are not included. Where the club or society holds a fundraising activity, the income and expenses of that activity should be set off against each other in an income and expenditure account. Accumulated fund. The accumulated fund consists of the surpluses less any deficits which have accumulated over the life of the organization. It replaces capital in the statement of financial position of the club or society. Preparation of a statement of financial position of the club or society. The principles applied in preparing a statement of financial position of the club or society are similar to those applied in the preparation of statement of financial position of the business. The statement of financial position of a club or society shows non-current assets, non-current liabilities, and current liabilities in exactly the same way as the statement of financial position of trading organization. The main difference is that there is no capital in the statement of financial position of a club or society, whereas a business is usually financed by an investment or capital from the owners. Members of a club or society do not invest money in the same way as the proprietor of the business. Because of this, the members are not entitled to make any drawings in the club or society with the surplus. This means that these surpluses will be accumulated within the organization to form a capital fund known as the accumulated fund. If the club makes a deficit, then the accumulated fund will decrease. This accumulated fund replaces capital in the statement of financial position of the club or society. Subscription. Subscription owing by the members are a debit balance on the subscription account and a current account asset in the a current account asset in the statement of financial position. Subscription prepaid by members are credit balance on the subscription account and a credit balance and a current liability in the statement of financial position. Subscriptions in receipts and payments account and income and expenditure account. The receipts and payments account shows the amount of subscriptions received during the financial year, but the income and expenditure account shows the amount of subscriptions relating to the financial year. This means that the amount received must be adjusted for any subscriptions owed by the members and any subscriptions paid in advance by the members. The calculation of the amount relating to the financial may be shown in the form of ledger account known as subscription account. This may be regarded as the account of the members in the books of the organization. Subscriptions owing by members will appear as a debit balance as they are a current asset to the club or society. Subscriptions paid in advance by members will appear as a credit balance as their current liability because the club or society has an obligation to provide a period of membership which has already been paid for. It is possible to have balances, to have two balances on the subscription account as the account is all for all the members and some may have paid subscriptions in advance and some may have not paid their subscription. At the end of the financial year, the account is closed by transfer to the income and expenditure account of the amount relating to that financial year. Subscriptions written off. A club may have a policy that subscription is remain unpaid after a certain period of time or written off. The entries are made similar to those in a business rate of an vehicle debt. The subscription account is credited with the amount written off before the subscription for the year are transferred to the income and expenditure account. These irrecoverable payments will be included in the expenses of in the income and expenditure account. Calculation of sales and purchases. As the accounts of clubs or societies are often incomplete, it is often necessary to calculate credit purchases and sometimes credit sales if goods are sold on credit. Before the preparation of income statement, the same principles apply when calculating these figures for a business which has not got a complete set of accounting records are followed. Calculation of accumulated fund. It is sometimes necessary to calculate the accumulated fund of a club or society. This can be calculated by applying the same formula used to calculate the capital of the business. In a business, assets is equal to liabilities plus capital. In a club or society, assets is equal to accumulated fund plus liabilities. Chapter 19, Part 1, Partnership Fundamentals. In In this chapter, we'll discuss partnership advantages and disadvantages of partnership agreement, contents of partnership agreement, interest on capital, drawings and loan, partners capital account and current account, capital account versus current account. Partnership. The earlier chapters related to business which were owned by only one person is sole trader. Another very common business is partnership. A partnership is a business in which two or more people work together as owners with the aim of making profits. Normally, there cannot be more than 20 partners in a business. Professional people such as accountants and solicitors often operate as partnerships. A large number of family businesses also run on partnerships. Sometimes a new business is formed as a partnership. Sometimes a partnership is formed in a sole trader wishes to expand his business. Sometimes a partnership is formed when two or more sole traders agree to amalgamate their business. A partnership business will maintain double entry records in the same way as a sole trader. At the end of the financial year, an income statement and the statement of financial position are prepared. However, partnership will prepare an extra account after the income statement. This is known as profit and loss appropriation account. Advantages and disadvantages. The advantages and disadvantages of partnership business. Before agreeing to enter into partnership business, a person must consider the likely advantages and disadvantages of such an agreement. The advantages and disadvantages are summarized as follows. Advantages. Additional finance is available, additional knowledge, experience and skills are available, the responsibilities are shared, the risks are shared, discussions can take place before decisions are taken. Disadvantages. Profits have to be shared among the partners, decisions have to be recognized by all partners, decisions may take longer to put into effect. One partner's actions on behalf of the business are binding on all the partners. The disagreements can occur. All partners are responsible for debts of the business. Partnership agreement. The partnership agreement is a document setting out the rules under which the partners will operate the business, including profit sharing arrangements. Contents of partnership agreement. Although it is not necessary to draw up a partnership agreement when forming a partnership, it is advised to do so. Drawing up an agreement can avoid misunderstanding and agreement status. The clauses of a partnership agreement cover many aspects of the business. This relating to the accounting usually include the following. Contents of partnership agreement. Amount of capital invested by each partner. Partners do not need to invest equal amounts. How partners and losses are to be shared. Profits and losses may be shared equally in proportion to capital invested or in some other ratio. If interest on partners' capital is to be paid, and if so, at what rate? This interest is a reward for the investing in the business rather than if all the partners invest the same amount, it may not be necessary to pay interest. Where partners invest different amounts, interest can be formed of compensation to the person who has invested in his capital. Contents of partnership agreement. If partners salaries are to be paid, and if so, what amount? If all partners share the work and responsibility equally, it may not be necessary to pay salaries. The salary can be form of compensation when one partner has a greater share of his work and responsibilities. If an upper limit is placed on partners' drawings, and if so, what amount? The business will benefit if partners keep drawing as low as possible. If interest on partners' drawings is to be charged, and if so, at what rate? This is method of discouraging partners from making drawings from the business, especially early in the financial year. Interest on drawings and loan. Interest and amount withdrawn is calculated from the date of withdrawal until the end of financial year. Interest on partners' loan is to be paid, and if so, at what rate? If an extra finance is required, a partner may take a loan to the business. To compensate for the loss of interest, they could otherwise earn interest on loan may be paid. Loans from partners. A partnership may borrow money from one of the partners if extra finance is required, particularly if it is needed for a specific period of time. Loans for partners are not part of the capital and are treated in the same as any other loan. Unlike investing additional capital, money lent to partners will be paid at an agreed time. Interest on the loan is a business expense and is not affected by the amount of capital. Preparation of a profit and loss appropriation. Preparation of profit and loss appropriation account of partnership business. The profit and loss appropriation account for the financial year is prepared after the income statement and shows how the profit for the year is shared between the partners. The profit for the year is transferred to this account from the income statement. Any interest on drawing charge to the partners increases the amount available to share, and this must be added to the profit. The appropriation profit shares detailed in the profit agreement for interest in capital and partnerships. Salaries are deducted. The remaining figure is known as the residual profit and is shared between the partners in the agreed profit sharing ratio. Partners capital account. Similar to a sole trader, each member of the partnership business has their own capital account in the nominee. These usually record permanent increase or decreases in the capital invested by the remaining part. Capital accounts prepared in this way are referred to as specific capital accounts. The capital account has a credit balance as the business owes this to the partner. Partners current accounts. Each member of partnership business also has a current account. Anything with the business partner becomes entitled to as interest on loan. Interest on capital, interest on partner salary, and share of profit is credited to this account. Anything with the partner is charged with such drawings and interest on drawings is in this account. Partner's current account. So credit balance and a current account represent the amount owed by the partner, and debit balance represents the amount owed by the partner to the business. If the partner's drawings are more than his or her total share of the profit, the current account will have a debit balance as per the partner, as the partner owes this to the business. If the partner's drawings are less than his or her total share of profit, the current account will have a credit balance as the business owes this to the partner. If current accounts are not maintained, interest in capital partner's salary profit share, where profit share drawings and interest on drawings are recorded in the capital account. Drawings account. The drawings account is maintained for each partner. The total of this account is transferred to the partner's current account at the end of the financial year. Capital versus current account. Only permanent increases and decreases in the capital are entered in the partner's capital account. Anything to which partner becomes entitled or is charged to be in the year is entered in the partner's current account. Capital and current account. Maintaining both the capital account and the current account for each partner, it is necessary to see the amount invested and the calculate the interest on capital. The current account shows the profit revenues and whether the drawings exceed the total profit share. Statement of financial position of partnership business. Preparation of a statement of financial position of partnership business. Statement of financial position of partnership is seen as that of sole trader with the exception of capital section. This measure with capital account and current account balances for each partner separately. It is not necessary to show all the details of the transactions in the current account. It is adequate to show the closing balance on each account. Chapter 20, Part 1, Manufacturing Accounts. Manufacturing account. In this lesson, we are going to discuss about manufacturing accounts. Manufacturing business, manufacturing account, elements of cost, work in progress, trading and profit and loss section, allocation of expenses, statement of financial position, year-end legacy. Manufacturing business. The previous chapter split business which are involved in trading such as wholesale or retail business. Sell them without changing the goods. There are of course manufacturing businesses which buy raw materials and convert into finished products which they can sell. The manufacturing business will maintain double entry records similar to those of retail and wholesale business. At the end of the financial year, in addition to an income statement and possibly an appropriation account, the statement of financial position in manufacturing business will also prepare a manufacturing account. The purpose of preparing this account is to calculate how much it has cost the business to manufacture the goods produced in the financial year. Manufacturing account. The manufacturing account is a part of the financial statements and is used to calculate the cost of goods produced. The elements of cost. The cost of manufacture is made up of four main elements. These are direct material. The first thing the manufacturer needs is raw material to make the finished goods. This raw material takes many forms depending on type of business. The baker will need wood, a furniture maker will need wood, a car maker will need steel and so on. Direct labor. The next essential cost for manufacture is the cost of the wages of the people who are employed in the factory. Depending on factory type of the business, there will be bakers, carpenters, machine operators, and so on. This cost is sometimes referred to as direct wages. The term direct labor includes only those people who are actually involved in the production of finished goods. It does not include the wages of supervisors, maintenance, staff, factory cleaners, and so on. These people have an important role in the factory but are regarded as indirect. The elements of cost, direct expenses. There are many expenses which a manufacturer can directly link with the product being manufactured. It may be that of every item that the manufacturer has to pay a fee. The manufacturer may have to hire a special piece of equipment to complete the manufacturing process. Such expenses are regarded as direct expenses. Factory expenses, factory owners. These are sometimes referred to as indirect factory expenses. These include all the costs involved in operating the factory which cannot be directly manufactured. Expenses such as factory rent and rates, factory heat and light, factory machine repairs, depreciation of factory machinery, indirect factory repairs, and so on are all regarded as factory owners. Preparation of manufacturing account. The cost of manufacturing the goods produced is calculated in the manufacturing account. The first item in the manufacturing account is direct. The cost of direct material used in the year is calculated in a similar way so that in which retailer calculates the cost of goods sold. The cost of ramp is actually used during the year is calculated as opening inventory of raw material, purchase of raw material, the slab inventory of raw material, closing inventory of raw material. The cost of direct labor is then added to the direct material. Any indirect expenses are then added. The total of these elements of three elements of cost is known as the prime cost. Direct material plus direct labor plus direct expenses is equal to prime cost. The total cost of production is found by adding the factory overhead to the prime cost. Prime cost plus factory overhead is equal to cost of production. Work in progress. Goods which are priorly completed at the end of the financial year are known as work in progress. The work in progress is excluded from the cost of production as these goods cannot be sold until they are completed. They do have some value, however, as it is, has some cost to get them to the present condition. Some material has been used and some direct wages have been incurred and so on. It is therefore necessary to place a value on the piece on the work in progress. The partly made goods at the end of the financial year are known as closing work in progress. These goods will of course become the opening work in progress at the start of the following financial year. In a manufacturing account, it is necessary to adjust the cost of production so that it represents only the cost of goods actually completed in the year. The adjustment is done in the same way as for any other type of inventory. The opening inventory is added and the closing inventory is added. Calculation of unit cost. Where a manufacturer makes only one type of identical product, the cost of making one article can be found by dividing the cost of goods completed by the number of articles manufactured. Trading section. Preparing of a trading section of an income statement of a manufacturing business. The gross profit of a manufacturing business is calculated in the trading account of the income statement. This is very similar to that prepared by wholesale or retail business. The main difference is that because the business actually makes the goods itself. The items for purchase is replaced by the production cost of goods completed. Sometimes, however, manufacturing business may purchase some finished goods which it does not manufacture itself. This may occur when production does not meet demand, when it is cheaper to buy the goods rather than when these particular items cannot be made. Purchases of finished goods are added to the production cost of goods completed in the income statement. In the trading section of the income statement, the profit from the sale of finished goods is compared with the cost of goods. This means that the inventories included in the inventories of finished goods are manufactured start and end of the financial year. Profit and loss section. Preparation of the profit and loss section of the income statement of the manufacturing business. The profit for the year of manufacturing business is calculated in the profit and loss section of the income statement. This is very similar to that prepared by wholesale or retail business. Expenses relating to the manufacturing process are already been entered in manufacturing. So only administration expenses, selling and distribution expenses, and financial expenses will appear in the profit and loss section of the income statement. Allocation of expenses. Where an expense relates to the whole of the business, it may be necessary to share this out between the factory and the office. Expenses such as insurance of building and rents and heat and light often have to be apportioned. For example, the insurance of the buildings may be apportioned to the factory and to the office. This means that if the total cost of the insurance was 900 and amount of $600 would be included in manufacturing cost and $300 in the profit and loss section. Financial position. Preparation of the financial statement of financial position of manufacturing business. Statement of financial position of manufacturing business is to the prepared by the wholesale market. There is only one main difference, that is, which manufacturer may have three different inventories: raw material, working product, and finished. It is usual to show each of these inventories separately in the term section of the statement of financial position. Year-end business. Year-end. This chapter is concentrated on the difference between the financial statement of manufacturing business and the business. In order to emphasize these differences, one of the examples include the year-end business. The manufacturer may well have to make year-end business for such pieces that was provision for documents and so on. Chapter 21, Part 1, Limited Companies. In this chapter, we discuss a company, private and public company, limited liability, related capital, share capital, types of shares, debentures, statement of changes in equity, financial statements. A limited company. A limited company is a legal entity which has separate identity from its shareholders. Whose liability for the whole company is debt is limited. Sometimes a new business is formed as a limited company. Sometimes a limited company is formed in a sole trader or partnership business to expand their business. Share capital. The nature of a limited company. One person acting alone can form a limited company and there is no maximum number of shares members. The capital of a company is divided into unit known as shares, which can be of any monetary amount. The member shareholders of the company are only liable for the debts of the company up to the amount they agree to pay their shares. Since a company can have a large number of members whose liability is limited, a large amount of capital can be raised. The shares of a company have a face value, par value such as $1, $5, $1, etc. Profits are distributed among the members in the form of dividends, which are often stated in terms of percentage of the face value of the shares. Public limited versus private limited company. There are two types of private limited company. A company, a public limited company, which often offer its shares to the public, and a private limited company, which is usually a smaller company, and is not allowed to offer its shares to the public. Limited liability. From the viewpoint of the individual, the main benefit of being a member of a limited company is the fact that the liability for the debts of the company is limited to the amount the members agree to contribute. It is also beneficial that the limited company has a separate legal entity to its shareholders. So legal actions are taken against the company, not the individual shareholders. Apart from very small limited companies, it is not usually practical for shareholders to take an active part in running of the business. So a board of directors is appointed to run the business and manage the business. If shares are held in a public limited company, it is easy to buy and sell shares. Greater capital. The viewpoint of the business being a limited company means that it is possible to access greater capital than it is possible for a sole trader or foreign business. Loans can often be obtained more easily by a limited company than by a sole trader or partnership members. The company has continuity of existence unlike a sole trader or a partnership members. However, there are many legal opinions in relation to forming and running a limited company, and annual financial statements will be prepared and provided to shareholders. Share capital. When a limited company is formed, the amount of share capital required is issued to the shareholders, and this is known as the share capital. If more capital is required to the table, further shares can be issued. A company may not immediately require all the money due on the shares it issues. In this case, shareholders may be allowed to pay in installments of time and amounts to the company. The total amount of money the company has requested from the shareholders is known as the called-up capital. This may be less than the issued capital of the company in the call-up, as may only call up the amount it actually requires at the day. The term paid-up capital refers to that part of capital called up capital for which company has actually received cash from its shareholders. Types of shares. The share capital of limited company is divided into different types of shares. The most common ones are preference shares and ordinary shares. Preference shares. As the name implies, these get preference over the ordinary shares. They receive a fixed rate of dividend based on the percentage of the shares, which is payable before any dividend is payable to the ordinary shares. The dividend is the same every year, provided that the profit of the company is enough to cover the amount. If the company is wound up, close down, and any left profit paying out liabilities is used to pay back the preference shares the ordinary shares. Preference shareholders are not usually entitled to vote for shareholders' meetings. Types of preference shares. There are several types of preference shares, and most of these are outside the scope of them. However, it is necessary to understand the difference between the redeemable and non-redeemable shares, and how the shares appear in the statement of financial condition. If the preference shares are redeemable, the dividend is included in the last with any accrued dividend appearing in the current liabilities in the statement of financial condition. The preference shares are shown as a non-current liability in the statement of financial condition. If the preference shares are non-redeemable, the dividend paid is included in the statement of changes in equity, and the preference shares are included in equity and reserves of financial condition. Ordinary shares. These are also known as equity shares. The dividend on ordinary shares is only payable after that on the preference shares. The dividend is not a but vary according to the profit. If the trading business supports the ordinary shares, is not even profit. If trading business are if a company is owned up, the outside liabilities and different shares are repaid before any units are into the ordinary shares. This may result in very little income to the ordinary shareholders if the company has shut up. However, the ordinary shareholders may receive a return higher than their original cash if the company has adequate funds. Ordinary shareholders are equally entitled to vote at shareholders meetings on the basis of one vote per share. Redeemable preference shares are those preference shares which may be bought back to the company on agreed date and for an agreed price. Equity is the total funds provided by the shareholders of the company. A debenture is a long-term loan which has a fixed rate of interest payable irrespective of the profit of the company. Debentures, no notes. In addition to the funds awarded by the ownership, the company also obtains debentures, which are long-term loans. Like most loans, debentures carry a fixed rate of interest, which is payable as the amount the company has. The loan interest appears as a finance cost in the profit section of the interest. If the company is owned as the debenture holders will be repaid before any capital is repaid. Debenture holders are not members of the company, so are not entitled to vote in issue. Income statement of a limited company. Income statement is provided for a limited company. The same as it is statement. The only difference is that the finance cost of the debenture is based on the statement of changes in equity and partnership accounts. It was explained how it was necessary to prepare a in a similar way, limited company for a statement how the profit for the this statement is not a statement of changes in equity. It summarizes the changes to the ordinary share capital, non-redeemable preference share capital, and retained earnings and dividends. It has already been explained that profits are distributed to the shareholders. Any ordinary share dividend and any dividend on non-redeemable shares is actually being paid in financial for that particular year. Sometimes the directors will implement an interim dividend that half-year dividend to be paid along during the year on ordinary shares and also on non-redeemable shares. This will appear in the statement of changes in equity for that particular year. At the end of the each financial year, the directors of the company present the ordinary share dividends and possibly dividends on non-redeemable shares are paid and these will be paid early in the following year. These proposed dividends are not included in the financial statement appear as you know. They are included in the statement of changes in equity in the year when they are actually paid. Very often, limited companies do not distribute the whole of the profit for their own. Even if a limited company is to distribute the whole profit, it will not be possible if there was not enough cash or any profit that is not appropriated for dividends described to the following year. This is known as retained earnings and will appear in the equity and reserves section of the statement of financial position. In addition to leaving a balance of retained earnings, many companies will transfer an amount from the profit for the net to a general. This is another means of profiting by profits in the company. The general reserve will also appear in the equity and reserves section of the statement of financial position. Statement of financial position. Statement of financial position of the limited company. The statement of financial position of the limited company. The asset section and the current liability sections are presented exactly the same as for the same period. The non-current liability section includes financial debentures and other non-current liabilities. The capital section is modified so that it shows details of the shares and the the general reserve and written earnings are added to the share capital as they represent profit written and as such belong to the ordinary shareholders.
Hey, remember, I'm a trainer, not a tutor. I train you to pass, to succeed, to clear your exams, to get better marks, to excel in your studies, so that you understand and do better and best. The best. It's okay, I've been taking on classes. I'm aware of difficulties faced by various students, below average, above average. I analyze and understand what they don't really understand and how the students suffer. I feel the person, try to understand their difficulties, making the student understand the subject and making interesting for them to learn so that they excel in their studies is my core perspective. These days, a lot of students have various difficulties. They won't understand anything in the class. A lot of students who are pursuing online classes. A lot of students who are taken up distance learning classes face various difficulties in understanding the core concepts. So they try to understand, but most of the teachers have different methodologies to explain, and few students are unable to understand. It's a hard time for the students. Myself, not being just learned, but having understood the subject as a common sense. I am a professional tutor, professional trainer, and educator, having on-job experience and theoretical knowledge in various subjects, such as direct taxes, indirect taxes, accounting, be it financial accounting, advanced financial accounting, cost accounting, advanced cost accounting, managerial accounting, advanced managerial accounting, management accounting, advanced management accounting, financial management, operations research, quantitative techniques, business mathematics, business statistics, business economics, business studies, and various other business management subjects. I even have on-hand experience in ERP, SAP, Tally, QuickBooks, and all. So I'm in a better position to explain the real logistical issues, the logistical problems, the core concepts in a better way. So a lot of students approach me near the exams for exam-oriented crash courses and exam-oriented coaching so that they pass their exams. I have a record 100% of my students clear my exams, clear their exams with ease. 100% they succeed. So I capable of understanding the concepts so as to make their life easier. So learning becomes pleasure and enjoy. So anyone who is interested, who wants to clear their exams with ease, without any difficulties, may please get in touch with me. I am available anytime for them. 24/7, I am available for them. Thank you. Sharing is caring. So please subscribe, share to my channel, because spreading knowledge only increases your knowledge.
Dear students, welcome to Shasha's virtual classroom. So this is the first session for IGCSE. So the lesson name Introduction to Accounting. So this is a text from Catherine Coupon, and we have another text. This is from this one Frankfurt. Okay, so what is there in accounting in as per Catherine Coupon is the same thing. So understand and explain difference between bookkeeping, accounting, purpose of measuring for business profit and loss, explain the role of accounting to provide information for monitoring progress. So explain the meaning of assets, liabilities, owner's equity. Explain and apply the accounting equation. Understand the statement of financial position. Record assets and liabilities in a specified way. So this is as per Catherine Coupon. So whether it is this book or Frankfurt's business accounting, it is the same thing. So here the lesson name of the lesson is accounting equation and the balance sheet. So ultimately the name of the lesson may be different, but what is the content? So what is the content is the same. So there are several books written by several authors, and again some institutes come up with their own notes, their own syllabus and all those things, but everyone will be within the ambit of syllabus that has been set by IGCSE book. So after you have studied this chapter, you should be able to, what are the objectives? Explain what accounting is about, so what do you mean by accounting? Describe the history of accounting. So explain the relationship between bookkeeping and accounting, so the same thing, okay? Bookkeeping and accounting. List the main uses of accounting information and what accounting information they are interested in. Present and explain the accounting equation. See, bookkeeping, accounting. Explain the relationship between accounting equation and the layout of the balance sheet. Okay. So balance sheet is nothing but statement of financial position. So it is also called statement of financial position. Explain the meaning of the term assets, capital, liabilities, debtors and creditors. So this is given in more detail here. So describe how accounting transactions affect the items of the accounting equation. So then draw balance sheets after accounting transactions are occurred. So all these things we are going to learn in this in today's class. So it might be a lengthy class. So but we'll discuss the important things. And we will divide it into two parts. So we will divide it into two parts so that it becomes easier for you also to understand, grasp, and even review, so revise or whatever. So we will start with all these concepts. Okay. So introduction to accounting or the accounting equation and balance. So this is the name of the lesson. So what is bookkeeping? So accounting equation and bookkeeping. So what is bookkeeping? See, a business needs to maintain details about the transactions being taken place. What are the transactions that take place in a business? Business may sell goods, may buy goods, may make the payments, may make payments over different accounts, like they may pay salaries, stationery. Similarly, then it may receive even commission. So many aspects are involved. So what does the bookkeeper do? Bookkeeper is the first person. A bookkeeper is the first person who records the transaction from the source. Okay, so he records the transaction, detailed record. Detailed record of accounting information, detailed record of business transaction. Okay. Detailed record of business transaction is It's called bookkeeping. So the bookkeeper does everything. He records everything in detail. Like he may record the bill number, the amount, the account on which it has been received. So many things. The first source. Okay, the first source. Of record. First source of record is made by bookkeeping. So that is known as bookkeeping. Okay. So then what happens in accounting? So whatever information is derived from this is converted into financial statements. So what are financial statements? Financial statements are nothing but income statement, wherein you find out what is the income we have received. Income statement, ultimate income statement. So position statement, so statement of financial position. It's also known as balance sheet, statement of financial position. And cash flow statement. So those are known as financial statements. So based on the data provided by bookkeeping, accounting is done. So what is the need? So any business cannot survive without profits, right? So after you do the business, you have to find out where are we standing, what is the status. So we have to evaluate ourselves. So that is why income statements are made. Income statements, we can find out what is the profit, what are the expenses, what is the revenue, what are the expenses we gain, and what are the expenses we have incurred, and the net amount, what is the net result. So that is what is income statement. So what is statement of financial position? We make a list of what we have and what is owing to the business, what we owe. So many things are there. So that you will understand once we come to equation and related concepts. So as of now, statement of financial position means assets and liabilities. So we will come to know what is this. So what is the need? So we need to understand. So that that is the main criteria for survival. So a lot of notes are available. So in the textbooks, you can refer the textbooks for a detailed discussion on this. So it's easy, so you can understand and you can write something on that. So then we will proceed to the main concept, the main theme of this lesson, which is equation and related concepts. Equation and related concepts and position statement. Okay. So you have to remember 5 components. So basically, so what is accounting equation? Accounting equation says assets is equal to liabilities plus owner's equity. So owner's equity is also known as capital. So this is also known as capital. Is equal to assets is equal to liabilities plus capital. So now you need to understand what are assets, what are liabilities, what is owner's equity. So all these things you need to understand. This is the first thing you need to understand. Okay. So you may refer first lesson in AS level cash transactions. Therein I have explained the first step in accounting equation. So chapter 1. Part 1. So you please refer chapter 1, part 1, and you can cross refer all the cash transactions, credit transactions up to lesson number 9, even up to 10 also. So the same thing you will study even in IGCSE, the same thing you study even in IAS level as well. So there the explanation is in a different way. So that if you want to understand, you can try to see, you can try to understand from there, or you can understand from here, but ultimately the concept is same. Okay, up to the lesson number 10, 8, 9, 10. Yeah, to lesson number 10. The concepts are almost the same. So if you can refer there also. So they are almost done. I have completed till lesson number 10 in AS level. So which will learn in IGCSE also. But in AS level, it will be somewhat more complicated, and it has been explained in some other way. So explanation, ultimate explanation and concepts are same. So if you don't want to confuse yourself, you can stick here. So I will be explaining the concept once again here also. Okay. So now, see, suppose a person starts a business. Okay, so let us say a person starts a business. So once a person starts a business, what does he use? He will use his money, cash balance. He will have some money in bank. He may have his own building. He may have his own machinery. He may have his own furniture. He may have his own furniture. So he may have his own computer also. So let's assume he has a cash balance $10,000. $10,000. Bank balance is another $5,000. Building is another $30,000. Machinery is another $10,000. Furniture is another $5,000. So computer is another $10,000. So let's assume this is just for assumption for you to understand. Okay. So he has started the person whoever he is. He has started a business with all these things. Okay. So the business will be using all these things to run the business. So business obviously needs all these resources. So these are resources. So 10,000, 5,000, 30,000, 10,000, 5,000, 10,000. What is the total amount? Total amount 10, 15. So 15, 45, 55, 60, 70, 75. So it's just illustrative. The amounts, it may be much more, but just for you to understand. Okay. So the business owner, has invested all these resources in the business. So now, there is one more concept known as business entity concept. Okay. So what is business entity concept? What does the business entity concept say? Business entity concept says these are the assets of the business. Okay. These are the assets of the business. So what are the assets? Assets are some resources which are used by the business, which have been provided by the owner to the business to earn the revenue. So that is what is assets. See, it is very important. Very initially, you may find it somewhat technical, but business, you have to understand accounting. This is very important. So this is very important for you to understand. So assets. Assets are, what are assets? Assets are resources used by the business to continue running the business. So now what is the business entity concept say? The business entity concept says that so much of assets are owned by business, but so much of money is owed to the owner. So this is known as owner's equity. So how much is owner's equity? Owner's equity is 70. So this is the liability, owner's equity. So owner's equity is the business entity, the business has to pay back the owner $70. The business has to pay back $70,000 to the owner. Why? Because the owner has given all these resources to the business. So understand, this is very clear-cut concept. So this is the main concept. So if you understand this concept, we can move further. So this is very important concept. Very important, very easy concept. So you may take some time to understand this, but please understand. So the business has assets as well as liability. Assets is something it has, and liability is something it owes. To whom it owes? It owes to the owner. Why? Because the owner has given the resources to the business. The owner has given resources to the business. That is why the business owes back. Okay. So, in that sense, should we consider that our owner is an outsider? Yes. Yes. Owner is considered as an outsider. So that is why the concept of capital owner's equity will come into picture. So whatever money the owner, the business owner puts into the business is referred as capital. The resources which are used by the business are assets. The money that is the owe money. So the liability, which is a commitment which the business has to pay back to the owner for providing the assets to the business, is known as owner's equity. So always assets are equal to liabilities. So suppose this person, this business, he has taken bank loan of $100,000. So there is cash balance, bank balance of 100,000. So now the assets are 170,000. So liability is also 170,000. Why? Because the business has taken resources of, bank loan means what you will get? You will get bank balance. Bank balance will increase. So the loan is given to the bank, so the bank balance will increase. So the business has to pay back. It is a commitment, right? So you have to pay back. No? So how can you cannot enjoy the money and you cannot say goodbye. So you have to pay back. You have to pay back. Bank loan is a liability. So it means owner's equity plus capital plus liabilities is equal to assets. Owner's equity plus liabilities is equal to assets. So what are liabilities? Even owner's equity is also liability, but it is internal liability. Internal liability means it has to pay to an insider, the person, the owner. But liability, bank loan is an outsider. You have to pay. So even this also you have to pay. This also you have to pay. So always assets are equal to owner's equity plus liabilities, and this is known as accounting mismatch. This is known as accounting mismatch. So now you have understood what are assets, what is owner's equity, what is bank loan, so what is liability. So the three concepts are clear. What are the concepts? Assets, owner's equity, liabilities. So what is the equation? What is the accounting equation? Accounting equation is assets is equal to liabilities plus capital of owner's equity. So in AS level, most of the times they use the word owner's equity. They never use the word capital. So some authors they prevent themselves from using the word capital. So So don't get confused, and ultimately the concept is important. So this is what it is. So the concept is crystal clear that assets is equal to liabilities plus capital or minus equity. So this is what we have learned till now. Accounting and related concepts. So accounting equation we understood. And this itself is also known as position statement. So what are the assets available on a particular day? The assets available are, these are the assets available. These are the assets that are available. And these are the liabilities that the business has. So this, when we put this in the form of a statement, it is known as statement of financial position or balance sheet. Okay. So we'll continue. Maybe in the next class we'll work out some questions. So we'll discuss this concept thoroughly. So what is the plan? The plan is we'll discuss questions from Catherine Kukom book, and even Franco. We'll discuss. So I will share you the questions so that they will be available on the screen. You can see on the screen. Then maybe you can pause the video and then you can answer yourself. Then after some time you can just check whether everything is correct. So ultimately, after doing all the lessons, we work out question papers as well. So we'll be solving all the question papers. So possibly how much our question papers are possible, MCQs, so different versions. All those question papers also will be solving, so that you are crystally very strong in your to write your board exams. Okay? So please subscribe, share. Please let others also know about this classroom, so virtual classroom. So help each other. So help me grow the channel also. Help me reach out to more students. So if you really like it, so if you have any doubts, please let me know in the comment section, so that I explain to you more and more different ways, so that it is clear. You can just check out all my other lessons, and if you find any errors or if you have found any mistakes or something like that, you can please let me know, so that I rectify it and again I can improve myself. So till then, good night, good day, good luck, bye-bye. So see you in the next class.
Dear students, welcome to Shasha's virtual classroom. So this is introductory accounting session. So hopefully you might have gone through the first lesson, introduction to accounting, the theory part. So now to start with, I just want to discuss certain points, certain important things with you. I believe that you are matured enough to understand whatever I discuss in today's session. See, accounting in IGCSE and A level. There is a accounting in IGCSE also and A level as both. Okay. So what is there in IGCSE and what is there in A level? That is what I am going to discuss. So how important is IGCSE for A levels? Okay. So in IGCSE we will be discussing all these lessons. So we'll be discussing, see, introduction to accounting, where you have accounting equation, all that stuff. So but this will not appear again in A levels. A levels in the sense AS level. So but the concepts whatever you are understanding here, is applicable to the entire accountancy subject. Okay, entire accounting subject. So concepts are very, very important. So try to understand. Okay, try to understand the concept. Understand. Okay. Don't have a casual approach. Don't have a casual approach towards the subject. Try to understand what you are doing, what you are learning, why you have to do a particular thing, why you should not treat a particular item, why, and all those things. So understand the subject as such. So that is what is concept. Okay. The concept should be clear. What is the concept? Concept is why not. You should answer yourself. If a teacher says that you have to treat a particular item like this, you should be able to answer why you have to treat and why you should not treat it in that particular some other way. So that is what is concept. When you have reasoning skills, okay, so reasoning skills. So you should develop reasoning skills. So this is the specialty of IG, Cambridge International Board. What is the specialty of Cambridge International Board is reasoning skills should be very strong, your concept should be very clear, and you should have understood the subject. That is what it is. So unlike other boards where you have to study lots and lots of things, but here you will be taught comparatively, you will be taught a lesser volume, but the in-depth will be very strong. Okay, so it's very important. So that is why they will be, the students of Cambridge International are very sharp. You have to understand the subject, you have to understand everything, whatever you learn, you have to understand. Don't do like how kids used to do 1 + 1, 2, 2 + 3, 5, something like that. So without understanding what normally some students do, they will just remember things and then they do. They don't understand, they just remember things and then they do. No, never do like that. So you have to understand everything, and you have to learn the subject. If you start understanding the subject, then the subject will become interesting for you, and if you feel like studying it again and again, you feel like you are a master in the subject, you are understanding everything. So ultimately, your A levels, you will score very high grades in A levels. So if you are very strong, so from the day one, ensure that you understand all the concepts. So we will be learning introduction to accounting, double entry bookkeeping. In this, we will be learning how to prepare ledger accounts, what is a ledger account. So here we will study what is asset, what is liability, various accounting terms, very important accounting terms, all those things we learn here. Then the trial balance. So what is a trial balance? So what is cash book? Cash, how to record cash transactions, like when you receive cash, when you pay cash. Then petty cash book, what do you mean by petty cash book? So various types of business documents, like maybe receipt, payment, invoice, voucher. So many documents are there in business. So any business will definitely have a document. Like suppose you go to a shop, they will give you a bill, right? They will give an invoice wherein they have written everything like what you have purchased and what is the amount payable. So that is what is a document. That is a document of one supermarket. Similarly, you transact, you go and buy anything from any shop, you will get a bill, you will get an invoice. So that is what is called document. So when you pay something, you give something, they give something. So that is what, because there is proper evidence of your payment, your receipt, or the transaction you have done with the particular business. Okay. So books of time entry. What are the books of time entry? Like you maintain sales journal, purchase journal, so cash book, so many things and all. So again, coming to the next part, financial statement. So this is income statement. This is part B is position statement. So income statement means to find out what is the profit you have got by doing the business. financial statement means position statement means what is the position of assets and liabilities. So what are the assets and liabilities that we will discuss in the first lesson. So accounting rules you have to follow in maintaining the books of accounts. You cannot write however you want because accounting rules should be followed universally. So you have to write the books of accounts. You have to understand the books of accounts in a proper way. Anyone who sees the books of accounts should be able to identify what the business is trying to tell. So other payables and receivables. So you may have to pay some money to some other person. So you may have to receive some money from the business people. So all those things. Accounting for depreciation and disposal of non-current assets. So what do you mean by non-current assets? What is depreciation? Irrecoverable debts and provision for doubtful debts. Bank reconciliation statement. So journal entries and correction of errors, control accounts, incomplete records, accounts of clubs and societies. This is called not for profit organizations, partnerships, manufacturing accounts, limited companies, analysis and interpretation. So this is all you will learn in IGCSE. So you believe it or not, most of this is again repeated in AS level. Okay. So most of it is again coming in AS level. So let us see what is coming in AS level. So this is a book by David Hopkins. So double entry bookkeeping, cash transactions, how you record cash receipts, cash payments. Double entry bookkeeping, credit transactions, how you record credit transactions, when you purchase on credit, when you sell on credit. Books of prime entry, it was there in here also, right? Books of prime entry, see. Books of prime entry. Okay. So again, balancing accounts, how do you balance? All those things, this balancing accounts, you will learn in part A. Part A or part B, you will learn here itself. So balancing account, you will learn either here also you will learn. So then, classification accounts, division of the ledger. So in this, you will learn in this double entry bookkeeping part B. So the same thing, but the lesson names are different. The classification of account, the trial balance. The trial balance is also here also. See the trial balance. So where is the trial balance? Trial balance is here also. So okay. So then income statement for sole traders. So financial statements part A, part B. Position income statement of financial position part B. So here it is a statement of financial position part B. So then accounting rules. So what are these accounting rules? So these are the accounting rules. So the same thing you have here also the accounting rules. So accounting principles or concepts in this itself. Accounting rules also along with this when you are learning the lessons here. So even along with this you'll be learning accruals and prepayments. See accruals and prepayments. Accruals and prepayment. This is nothing but the same thing. Other payables and other receivables are nothing but accruals and prepayables. Then provision for depreciation of non-current assets. So provision for depreciation of non-current assets with accounting for depreciation and disposal, irrecoverable debts and provision for doubtful debts. Irrecoverable and doubtful debts, bank reconciliation statement. Bank reconciliation statement. See bank reconciliation statement, control accounts, journal entries and correction of errors. Journal entries and correction of errors that will come in suspense account here. So again, where is it? The trial balance also. So again, books of prime entry also you get some entries. So then control accounts. Control accounts are here also, right? Control accounts are here also. See, control accounts are here also. So this is A levels, AS level and A level. Both. So one subject, one book for both. Okay. So till here, there is this is AS level. From here onwards, it's A levels. So now coming to Again, so what happens? Then control accounts, incomplete records. See, where are incomplete records? See, incomplete records. Accounts of clubs and societies, not for profit. Accounts for clubs and societies. So where is it? Not for profit organizations. So here, see in A level. Okay. See, one part is there in A level also. See, whatever you learn here. Accounts of clubs and society is not there. This is there in A level. So you have to be very strong. Okay. So then partnerships. See, partnerships. Where is it? Till here. So it is A level. Partnerships. Partnership changes onwards, we will have in A level. Okay. From here onwards, it's A level. Partnership changes. So till here you have in AS level. So this is AS level. Okay, now partnerships, manufacturing accounts. See, manufacturing accounts. So where are manufacturing accounts? See, A level. Okay, see, one lesson is there in A level. See how important limited companies, accounts of introduction to accounts of limited companies. Introduction to accounts of limited companies. A portion is there in A level also, a portion is there in AS level also. This is split into two, AS and A level as well. Okay, now then manufacturing limited companies, analysis and interpretation. Analysis and interpretation, see here, the last lesson in this. Analysis and communication of accounting information. So basically, what I want to tell you is, so please focus on learning more and more points in IGCSE, so that your A levels become easier for you and the scoring becomes easy. So in the course of the classes, we will be doing questions from this book. So we will be solving question papers, previous year question papers, a lot of important questions, and even in AS level and A level also we will be solving a lot of concepts, important question papers, and a lot of other important stuff. Okay, so basically here I just want to help you. So we just want to help you in understanding the subject accounting, so that it becomes easier for you to score high. And so I just want you to tell that IGCSE is equally important. So don't ignore anything. Take it seriously. Understand the concepts itself. So make use of. So what you can do is, you can even start answering some questions from AS level also. So related questions also you can try. So you can be way forward, so that you prepare for A levels right from the initial stages, right from IGCSE level itself. You are ready for A levels. You should be ready for A levels. So you should be very proactive, so that you get very high marks, very distinctive marks, so that today's world is very competitive. So I have seen a lot of students dropping out from accounting subject because they feel accounting as a very tough subject. They are not capable of handling. Most of the students less very grades, and normally they will lose interest and all those things. So, but if you understand the concept, it's very simple. But try to understand the concept. If you understand each and every lesson, it means you are able to understand the concept. That is what it is. Also, what do you mean by concept? What do you mean by concept means? Concept means if you are capable of understanding and solving the questions on your own, then you have understood the concept. So whenever I place a question in front of you, so what you can do is, you can just take a screenshot of that, try to answer on your own, and then you can just check the answer with the solution. So this is how your progress should be. So ultimately you will understand, and if you have any difficulty in understanding, you please let me know. as a comment in the section. In the comment section, I will explain to you in several ways. I explain to you in several ways. Don't hesitate. Don't think you look like an idiot. So please feel free to ask me any doubt, whatever, even if it is very silly doubt. Please feel free to ask us. So we are here to help you. We are here to guide you, understand the subject, and prosper in your academics. So next class we'll start with first lesson, Introduction to Accounting. So here we will learn a lot of important concepts like what do you mean by assets, what do you mean by liabilities, what is accounting equation. So then what is bookkeeping, what is accounting. So a lot of other concepts we will learn in the first lesson. Then second lesson we'll learn how to record a ledger, what is a ledger. So all those things we'll learn in second lesson. So here onwards, gradually we'll be learning one by one lesson. So after finishing all the lessons, we'll start working out even the question papers. We'll start working out the question papers as well. So this one, CIE question papers. Okay, Cambridge International Examination question papers. So we'll catch up in the next class. Till then, have a good day, good night, bye bye.
Chapter 14, Bank Reconciliation Statement. Understand the use and purpose of bank statement. Update the cash book for bank charges, bank interest paid and receipt, collection of errors, credit transfers, debit, direct debits, dividends, and standing orders. Understand the purpose of and prepare a bank reconciliation statement. Bank errors, uncredited deposits, and unpresented checks. Journal entries and correction of errors. Explain the use of and process accounting data in the book of prime entry, the general ledger. Post the ledger entries from the general ledger. Prepare journal entries for the provision of depreciation. Prepare journal entries to record the sale of non-current assets. Prepare journal entries to record accrued and prepaid expenses. Prepare journal entries to record accrued and prepaid incomes. Prepare journal entries to record irrecoverable debts. Prepare journal entries to record recovery of bad debts written off. Prepare journal entries to record the creation of adjustments to provision of doubtful debts. Correct errors by means of journal entry. Explain the use of suspense account and as a temporary measure to balance the trial balance. Correct errors by means of suspense accounts. Adjust a profit or loss for an accounting period after the correction of errors. Understand the effect of correction of errors on a statement of financial position. Control accounts. Understand the purpose of purchase ledger and sales ledger control accounts. Identify the books of prime entry as sources of information for the control account entries. Prepare purchase ledger and sales ledger control accounts to include credit purchases and sales receipts and payments, cash discounts, returns, reported CS financials, interest on audio, contra interest, refunds, opening and closing balances, debit and credit within each account. Incomplete record. Explain the disadvantage of not maintaining a full set of accounting records. Prepare opening and closing statement of affairs. Calculate profit for the year from the changes in capital over time. Calculate sales, purchases, gross profit, trade receivables and trade payables, and other figures from incomplete information. Prepare income statements and statement of financial position from incomplete records. Make adjustments to the financial statements. Apply the techniques of market margin and inventory turnover to arrive at the missing figures. Accounts of clubs and societies. Distinguish between receipts and revenues account and income and expenditure account. Prepare receipts and revenues account. Prepare accounts for revenue generating activities, refreshments, subscriptions, etc. Prepare income and expenditure account and statement of financial condition. Making adjustments of financial statement. Define and calculate the limited partnerships. Fundamentals. Explain the advantages and disadvantages of forming partnership. Outline the importance and benefits of partnership agreement. Explain the purpose of an appropriation account. Prepare income statements, appropriation account, and statement of financial position. Record interest on partners' loans. Interest on capital, interest on drawings, partners' salaries, and the division of balance of profit or loss. Make adjustments to financial statements. Explain the uses of and differences between capital and current accounts. Draw partners' capital and current accounts in ledger accounts. Form and as for product statement of financial position. Manufacturing accounts. Distinguish between direct and indirect costs. Understand direct material, direct labor, prime cost, and direct overheads. Understand and make adjustments for outcome performance, calculate capital cost of production, prepare manufacturing account, income statements, and statement of financial position, make adjustments to financial statements. Limited companies. Explain the advantages and disadvantages of operating as a limited company. Understand the meaning of term limited liability. Understand the meaning of term equity. Understand the capital structure of limited company comprising preferential capital, ordinary share capital, general reserves, and retained earnings. Understand and distinguish between issued, called up, and paid up share capital. Understand and distinguish between share capital, preferred shares, ordinary shares, and loan capital. Prepare income statement, statement of changes in income statement of financial position, make adjustments to financial statements.
Chapter 4, Part 1. Contents. Categorization of ledger accounts, sales ledger, purchase ledger, nominal ledger, cash book, the 2-column cash book, contra entries, bank overdraft, the 3-column cash book, cash discount, discount allowed and received. Categorization of ledger account. Sales ledger, the ledger in which the accounts of credit customers are maintained. Purchase ledger, ledger in which the accounts of credit suppliers are maintained. Nominal general ledger, the ledger where all the other accounts are maintained. Sales ledger. This is also referred to as the debtors ledger or trade receivables ledger. All the personal accounts of credit customers are kept in the sales ledger. Purchase ledger. Purchase ledger. This is also referred to as the creditors ledger or trade payables ledger. All the personal accounts of credit suppliers are kept in the purchases ledger. Nominal ledger. This is also referred to as the general ledger. Apart from the cash book, the bank account, and the accounts of credit customers and credit suppliers, all the remaining accounts are kept in the nominal ledger. This ledger will contain an account of assets, liabilities, expenses, income, sales, purchases, and returns. Asset account are also known as real accounts. Accounts for expenses, income, and capital are known as nominal accounts. Cash book and petty cash book. Cash books. These contain the main cash book wherein all amounts received and paid in cash and checks are recorded. On the petty cash book contains details of small amounts spent daily on various accounts are recorded. The 2-column cash book. The 2-column cash book explains how two separate accounts, a cash account and a bank account, are maintained to record the movement of money. In practice, it is common for these accounts to be moved from ledger and shown in the separate book account, book shown as the cash book. The cash account and the bank account appear side by side in the cash book. The rules of double entry bookkeeping are still applied. Any money received is debited in the cash book. If the money is placed in the cash till, it will be entered in the cash column, and if it is paid into bank, it will be entered in the bank column. Any amount paid out is credited in the cash book. If the amount is paid in cash, it will be entered in the cash column, and if it is paid out of the bank, it will be entered in the bank column. Whilst the cash account and the bank account appear side by side, they still keep their own identity and must be balanced separately. Since the cash book is part of double entry system, it represents ledger account for both cash and bank. It is, however, also a book of prime entry because it is one of the books in which transactions should be recorded, therefore being entered in the ledger. Contra entries. Contra entries sometimes surplus cash is paid in the bank or money may be drawn from the bank to place in cash. Such transactions are known as contra entries because they appear on both sides of the cash book. Debited to one account, credited to the other. These transactions are recorded by applying the usual rules of double entry by debiting the account, receiving the money, and crediting the account, giving the money. The name of the account where the double entry is made is written in details column. In each case, the letter C is usually entered in the folio column to indicate that double entry is on the opposite side of the cashier. Bank overdraft. As explained earlier, the cash column and the bank column of cash book are balanced separately as they represent two separate accounts. The balance on the cash column will always be brought down as debit balance at the start of the next trading period. The only exception to this is when there is no cash left in the cash account. In which case the balance will be nil. It is not possible to have a credit balance on a cash account. It is, however, possible to have a credit balance on a bank account. The bank may allow the business to have bank overdraft. This means that the bank allows the business to pay out more from the bank than it is put into the bank. Interest will be charged by the bank on the amount withdrawn. In the cash book, the bank account is balanced in the usual way and the balance will be brought down on the credit side. This represents the amount the business owes the bank and its liability. The 3-column cash book. Many businesses maintain a 3-column cash book rather than a 2-column cash book. The difference is that the 3-column cash book has an extra money column on each side to record cash discount. The 3-column cash book. The 3-column cash book. Many businesses maintain a 3-column cash book rather than a 2-column cash book. The difference is that cash discount is recorded. Cash discount is an allowance given to the customer when an account is settled within a limited time limit set by the supplier. An account does not have to be paid in cash to qualify for cash discount. The time of payment is the deciding factor rather than how the account is paid. Cash discount is a means of encouraging customers to pay their account promptly. The supplier will receive an amount slightly less than the due amount. However, the money is paid earlier and so it is available for use within the business. Cash discount. The 3-column cash book has an extra money column on each side to record cash discount. Cash discount is allowance given to customer when an account is settled within a time limit set by the supplier. An account does not have to be paid in cash to qualify for cash discount. The time of payment is the deciding factor rather than how the account is paid. Cash discount is a means of encouraging customers to pay their accounts promptly. The supplier will still receive an amount slightly less than the due amount. However, the money is paid earlier and so it is available for use within the business. Cash discount allowed and received. Cash discount allowed is the discount business allows its credit customers when they pay their account within a set time. This is an expense of the business that is the most cost of having debt settled promptly. Discount received is the discount of business receives credit suppliers when it pays their account within a set time. This is an income of the business which is the benefit received from settling debts promptly. It is important to realize that discount received does not involve the receipt of the money. The supplier simply accepts less money in settlement of the account. Dishonored check. A dishonored check is a check received with the debtor's bank refuses to pay. This may occur because the debtor does not have enough money in her bank account, or it may be because of an error of the check. Example: no signature, no date, the amount in words and the amount in words. If a check is dishonored, it is returned to the business that paid the check into the bank. The business must record the return of this check by creating the bank account and debiting the debtor's account. The reverse of the entries made when the check was received. The business will also inform the debtor that this amount is unpaid.
Chapter 14, Part 1, Bank Reconciliation Statement. Chapter 14, Bank Reconciliation Statement. Learning objectives. In this chapter, you will learn to understand the use and purpose of bank statement and update the cash book for bank charges, bank interest, paid and received, correction of errors, credit transfers, direct debits, dividends, and standing orders. Understand the purpose of and prepare a bank reconciliation statement to include bank errors, uncredited deposits, and unpresented checks. We discussed a bank statement, comparing cash book with bank statement, the opposite side, classes of difference, timing difference, items not recorded in the cash book, differences in investigative, stages of bank reconciliation, prepare bank reconciliation statement. The bank statement. The bank will send a statement or regular intervals to its customers detailing the transactions that have taken place in the period covered with the statement ensuring the bank balance at the end of the period. This is similar to the statement of account issued by its request for customers that purchase goods on credit. The bank statement is a copy of customers' account inside the bank. This is the record of transactions as they affect the bank. When money is paid into the bank, the customer's account will be credited as this is the amount owed to the bank to the customer. And when money is taken out of the bank, the customer's account will be debited as this reduces the amount owed to the bank to the customer. A positive bank balance will appear as a credit balance and an overdrawn balance in the debit. Comparing cash book with bank statement. The entries on the bank statement are compared with those in the bank account. In the bank statement, we found there are recorded opposites with the account. The bank account is a record of transactions in the business. Money paid into the bank is debited. The bank is debtor for this amount, and money withdrawn from the bank is credited. The money is credited for this amount. It is important to compare the bank statement and the bank account in the data. If the two balances disagree, it is necessary to reconcile them to explain where the difference lies. The opposite side. The entries in the bank column of the cash book will appear on the opposite side to that on which they are recorded on the bank statement. Causes of difference. Reasons why the bank account and the bank statement may differ. Differences between the two records usually occur because of the different amount at which the same amounts are recorded. The business not recording certain items in the cash book. Timing differences. These are usually due to checks not presented, not yet presented. These are checks that have been paid with the business and entered on the credit side of the cash book, but which do not appear in the bank statement.
This may be because the payee has not paid the check into the account into his bank, or because the check is still in the bank. Amount not yet created. These are check and cash and check that have been paid in the bank and which do not appear in the bank account. It usually takes a few days before the money paid in the bank is recorded in the customers. Items not recorded in the bank. It often happens that the business does not record certain items until the bank statement is received. This includes bank charges and bank interest. The bank may deduct an amount from the customer's account to recover the cost of running the account, and for any interest charge and overdraft amount. This honor the check paid into bank may be returned because the drawer did not have sufficient funds in the account. Amount paid directly into the bank. These are credit transfers, standing orders, and direct debits where a person has entrusted the bank to an amount of money directly into the bank account of the business. Amounts paid directly by the bank to others. This includes credit transfers, standing orders, and direct debits with the business has introduced the bank to pay directly from the account of the business. Differences investigated. Any difference between the two records may be investigated. The errors made with the business should be recorded. The errors made by the bank should be notified to the bank. The differences between bank account and the cash account and the bank statement are summarized. The differences between the bank account and the cash book and the bank statement is summarized. Items in cash book not in bank statement. Checks not yet presented, amount not yet created, errors in cash book. Items in bank statement but not in cash book. Bank checks and bank interest, resummation checks, signing orders, credit transfer, direct debit, errors on bank statement, dividends. Stages of bank reconciliation. Compare the bank account and the cash book with the bank statement. The debit side of the bank account should compare with the credit side of the bank statement. And the credit side of the bank compare with the debit side of the bank statement. Put it in those items which appear in both records. Stages of bank reconciliation. Update the cash book, enter in the cash book, any items which appear in bank statement may not be entered in the cash book. Items debited on the bank statement, bank charges, credit transfer, credit balance, etc. should be credited to the bank account and the cash book. Items credited on the bank statement, example, credit transfer and direct debits paid in the bank should be debited to bank account in the cash book. Stages of bank reconciliation. Correct any errors in the cash book, balance the cash book and carry down the balance. This balance is the correct bank balance. If it is the end of the financial year, this is the balance which should appear in the statement of financial position. Prepare a bank reconciliation statement. This should show why the balance on the updated cash book does not agree with the balance shown on the bank statement. Start with the balance shown on the bank statement. Add any items which appear on the debit side of the cash book but which do not appear on the bank statement. Amounts not yet created. Deduct any items which appear on the credit side of the cash book but which do not appear on the bank statement. Checks not yet presented. Make any adjustments for a bank error, adding amounts debited in the end of the bank and deducting amounts created in the error to the bank. The total of this calculation should be equal to the updated bank balance in the cash book. Another way, it is possible to start the bank reconciliation statement with the updated bank balance. In this case, it is necessary to give a certain C and D, and bank reconciliation statement does not form part of the double entry record. It is a statement which shows that on a certain date the bank account and bank statement balances are reconciled. Bank reconciliation. When there is a bank overdraft, exactly the same principles are followed when there is a bank overdraft. In this case, it is important to take great care with the calculation, which is helpful to place brackets around overdrawn amounts. The bank overdraft will appear as the credit balance in the bank account in the cash book as the business and as a debit balance on the bank statement. Advantages of bank reconciliation. The advantages of reconciling the balance in the bank statement is better shown on the bank account in the cash book, or after updating the bank account, an accurate bank balance is available. Errors in the bank account or an bank statement can be identified. It assists in discovering fraud and not going to bank can be identified. Checks not yet presented can be identified. Any stale checks, these are usually those which are over 6 months old, they will not be made by the bank can be identified.
आंटी अब 30 रुपए एक नारियल 60 को तो ले लेंगे आप आंटी तेरे सी नवत सो सबसे 10 रुपए नहीं दिया नहीं मैं भी खाली 10 रुपए दिया तेरा काम बचा
O aniversare cât 20 de ani petrecuți împreună. Ne vedem la Rome Expo pe 23 și 24 august la petrecerea 20 de ani Kaufland. Să ne bucurăm de artiști iubiți, Smiley, Horea Brenciu, Teo Roz, Carla Streams, Direcția 5, de produsele cu care am crescut și mai ales de oamenii dragi. Intrarea se face pe baza cuponului gratuit din Kaufland Card. Activează-l! Kaufland!
Selamat berpuasa dan salam Ramadan. I have so much respect for everyone who is fasting this Ramadan because it's really not easy needing to wake up so early for sahur, then fasting the entire day with no food, no water, but still trying to stay productive and having a good daily routine. Mungkin ramai yang tak tahu saya sebenarnya membesar di Malaysia, sebuah negara Islam. Oleh itu, saya sudah terbiasa dengan budaya dan tradisi orang Melayu. Saya pun kadang-kadang turut berpuasa dengan kawan-kawan untuk berhungry dan berthirsty dengan mereka. So in this video, we'll go through the ultimate study guide for Ramadan, or how to study when you're feeling tired, how to structure your study sessions around fasting, how to stay productive even when you're exhausted, and how to avoid procrastination when all you want to do is nap, including what to do when your family is noisy and won't leave you alone, even though you need to get work done. Let's go. First, deciding when to study. When I asked you on Instagram, most of you said that you like to study either in the morning or at night, but the best approach is to actually do both. But there is a strategy to this. Whether you're a morning person or a night owl will determine the kind of work you should be focusing on during those times. A really easy way, bestie, to figure out when you work best is just by identifying your chronotype. There are actually 4 sleep chronotypes, so there's the bear, lion, wolf, and dolphin, and each one of them has a different peak energy period. Your chronotype will determine your best productivity times when your mood is naturally elevated and the best times for eating, sleeping, and studying. I'll leave the link to the quiz that I took personally in the description box below. So that's the first thing that I want you to do, bestie, after you finish watching this video, because once you've identified your chronotype, it's time to structure your perfect study session for maximum efficiency. So, how to choose the right tasks for your study sessions based on your energy levels. Your peak productivity periods, which will be different depending on your chronotype, should be spent on high focus tasks, while your low energy periods should be spent on less demanding work. Examples of high difficulty tasks are doing past year papers, anything to do with complex problem solving, essay writing, exam revision, deep learning, and memorization. So that means if your peak productivity periods are in the morning, you should be doing these tasks after subuh. But if you're a night person, you would be doing these tasks after isha. So this includes subjects like mathematics or sciences, or any subject that requires deep concentration and a lot of brain juice. And if you have a weak subject that you really want to improve on, this is the best time to work on that. I used to struggle a lot with mathematics. I don't know, me and numbers just don't get along. So what I would do is I would wake up at 4 a.m. every single morning before school starts to do 2 past year papers. And I actually went from scoring C's to distinction in A-levels. Now, what kind of tasks do you do during your low energy period? So for my night owls, that's after Subo, and for my early birds, this is after Isha. This is the time for you to write notes, review them, do homework, flashcard revision, and light reading. Tasks that don't require as much brain power to do. I really like using my low energy periods to recap information that I memorized in my high energy periods. But if you want my honest advice, bestie, you should be using this time during Ramadan to adjust to your body clock and become more of a morning person. Why? Because classes and exams are held in the morning, so training yourself to be more alert during those times will really help you perform better and improve your grades. So if you ever wanted to fix your sleep schedule, then this is the perfect time to do it. And if you want more tips on how to become a morning person, you can check out my video here. But like this video and subscribe if you're enjoying it so far. But if you're feeling exhausted, especially during Ramadan, which is completely understandable, the best way to be productive with minimal effort is by turning your phone from a distraction into a tool. I've spoken about this before, but you don't even need to get out of bed. You just switch to a more productive app. You can learn languages or play chess, but personally, I have no interest in those, so I use this app called Brilliant instead. I've been recommending this app for the past 3 years, but basically, it just turns any complicated STEM subject like engineering, programming, AI, computer science, and they turn it into game-like, fun, bite-sized lessons. It seriously looks like a game, but you're actually learning something. I am pretty sure that Brilliant just updated their math courses, so now the additional content will focus more on problem solving and logical reasoning, so if that's what you're interested in. My favorite are, of course, the science courses, and so you learn how to think like an engineer and develop your scientific intuition, but honestly, it's just a really good way to determine if that's what you want to pursue in university. You can actually try Brilliant for free for 30 days by scanning this QR code that I'll put on the screen, or you can visit brilliant.org/fayfilms. I'll leave this link in the description box below because you can also get 20% off the annual premium subscription by using the same link. Next, how to maximize your productivity. When we're tired, we won't be able to finish everything on our to-do list, and that's okay. And so what should you prioritize when your energy is low? We're going to use something called the eat the frog technique. I don't know why they chose frog, but let's just go with it. Basically, bestie, you'll start your study session by tackling the hardest, most challenging task first. For example, if you have a project deadline, an upcoming exam, or a long essay to write, that will be your frog. Again, why frog? People will tell you to do this because it builds momentum and it gets the hardest thing out of the way, but I'm going to tell you that the more important thing is that doing this gives you flexibility. If you're a morning person and you don't finish your task, you still have the rest of the day to complete it. If you're a night person, you can get the bulk of the work done before midnight and you can finish it up in the morning when you have less energy. And I say this out of experience because in Malaysia, Ramadan almost always coincides with exam season, which is really unfortunate. So me and my friends, remember how I used to fast with them to just give them support? We found out that getting the hardest work done first make a huge difference. When you're tired, you can fall into the trap or the habit of pushing things like revision or memorization back day after day after day because you're too tired to do them. Let me know if you also struggle with this in the comments, bestie. So instead of working on them when you feel like it, just tell yourself to start with those difficult tasks first, and then you can move on to the rest. An advertisement might play in the next few seconds, so if you would like to support this channel, please do not skip the ad. Thank you. But how do you shorten your study sessions? Here's the trick to actually getting work done efficiently to shorten your study sessions. Whatever the amount of time you think you need to complete a task, cut it in half. So if you think you need 2 hours to finish your notes, give yourself 1 hour instead. Instead of dragging out an 8-hour study session, you get the same amount of work done in just 4 hours. And what do you do with that extra time? You can either use it to rest and recharge or shift it to morning or night to refine the work that you just did. Remember what I said in my How to Be a Perfect Student video? You might tell me, if I spend half the amount of time making notes, it's gonna look like a chicken made it. Or if I spend half the amount of time revising, I probably get all the questions on a past year paper wrong. And that is completely true. However, if you don't get stuff done, you don't know how to improve. If you want a deep dive into a lot of non-basic study tips that will transform you into a top student, then you can check out my video here. Next, what if my family is noisy? Can you tell that I'm Southeast Asian? Because Southeast Asians know the struggle when it comes to having a noisy family. During Ramadan, I know a lot of you will struggle with getting work done because your family is all awake and your siblings, are bothering you in one ear and your parents are nagging you in the other ear. So here are a few small changes that can make a world of a difference that you can try. You can try putting on headphones and listening to white noise or brown noise. YouTube has many options and I find that this is less distracting than actual music. Or you can listen to lo-fi. So I already have 2 study with me sessions posted online. I will film more, I hear you. I'll leave them in the description box below. You can put that on and feel like you're studying with me in the library instead of a distracting environment. But if your family is noisy no matter what my friend did was that she tried to get as much work done in school or outside before she got home. So during lunchtime, because she can't eat, she'll sit with us and do her work instead, or in between classes when waiting for teacher, and sometimes she'll even stay in the library before going home. If all else fails, bestie, just embrace it. Embrace the chaos and be able to work in a noisy environment. You will build an insane ability to focus anywhere, which is a superpower, by the way. This will really help you during exams, in workplaces, or just life in general. If you've made it this far into the video, comment down below what you're grateful for this Ramadan to get triple the blessings in return. Thank you to my dear friend Sophia Amira, my old tuition teacher Cikgu Sabaria, and all my Muslim besties who wholeheartedly gave me their advice and contributed to this video. Remember to like this video, subscribe, and turn on the notification bell and set it to all so that you don't miss out on any future uploads. Thank you for 1,370,000 subscribers, and I'll see you all in my next video. Bye, bestie.
Dear students, welcome back to Shasha's virtual classroom. This is a small rectification video. Okay, so rectification video in the sense, it is a very small rectification, minor rectification. So in the previous class, that is chapter 1, page 4a, we had done this problem. So in this, 12,500 minus 1,800 is 10,700. So 10,700. So whereas in the answer in the previous class, it was mentioned as 11,700. So it was a small mistake, but it was not brought to my notice. So I felt very sorry for my dear students because they didn't let me know about the mistake. I would have rectified it long back. So now, just after going through my own videos, own classes, once again I just found out this small mistake. So please, students, please let me know if there is any error, because even I am a human being. So it's a very small mistake. So instead of instead of 10,700, I have taken 11,700. So please let me know. Okay. So that's all. So we will continue with chapter 1, P4B. Going further. So dear friends, today's class
we will discuss some questions based on lesson number 1, the first chapter. So based on those concepts, accounting equation lesson concepts. So here we will discuss. So before that, just have a. So this is Frankfurt's book. If you haven't answering them. If you haven't already started answering them, you now have a set of graded review questions to try. Graded means that they get more difficult as you go through them. Ideally, they should be done in the sequence as they appear. However, don't forget that the questions with an A after the question number do not have any answers provided in this book. Your teacher or lecturer will be able to provide you with the answers to these questions, but be sure to attempt them first before asking for the answers. The answers for other questions can be found at the back of the book. We realize that you would like to have all the answers in the book. However, teachers and lecturers could not then be able to test your knowledge with questions from this book. As you would already possess the answers, it is impossible to please everyone, and the compromise reached is that of putting a large number of review questions in the book. Okay, so this is very important. So a wise decision by Frankfurt. So I 100% agree to this. So this is what is my approach. So whenever you see any questions, you have to first try answering them. So if you are unable to answer them, then you have to just go through the lesson once again, try to understand, then again try to answer it. Okay, so these are the questions now. Frankfurt. So okay, so we'll start discussing. This means that appropriate reinforcement of what you have learned can take place even if you are studying on your own and have to miss out the AL questions because you have no access to the answers. Multiple choice questions. But in this lesson, in this class, in virtual classroom, we'll discuss all the questions. Okay. So whether they are AL questions or whatever. So before that, we just try to answer yourself. So multiple choice questions. So now here you can see what is the complete the gaps in the following table: assets, liabilities, capital. So what is the equation? Assets is equal to liabilities plus capital. So that is the equation, right? Assets is equal to liabilities plus capital. So if this is 12,500 and this is 1,800, what this will be? This minus this, that's also 12,500 minus 800. 11,700. So the first answer is 11,700. So 28,000 minus 4,900 is again 28 minus 5 is 23. $23,100. So 16,800 minus 12,500. $4,300. So this one will be 25,500. You have to add this and this, so that will give you this number. So okay, here also 19,600 minus 16,440.
19,600 minus 16,450. 3,150. So this is, so this would be this plus this. 11,650 plus 39,750. 51,400. Okay, so that's also simple it is. So I think this one you can try. So we'll discuss these questions in the next class. Okay, so we'll discuss in the next class. Then very next class we will discuss this. So now you can try answering this on your own. So maybe you take a screenshot of this and you can start working out and you can keep it ready and you can see IGCSE C1 P 5 I believe. Okay, 5 or 6. Okay, C1 P5 or 6. So they are all related. So I am giving the one number for each and every lesson. So in a sequence so that you can easily follow them and you can understand in a better sense. So you have to go it in a logical order. So see, that is what even the author has recommended. So see what the author has recommended. If you haven't already, see here you can see. They should be done in the sequence they appear. Okay, they should be done in the sequence that this is very important. So we will also go lesson wise, we'll go everything topic wise, concept wise, we'll go one by one so that the concept understanding is clear to you. Which are the following items in the following list are liabilities and which of them are assets? Loan to C. Shirley. Loan to C. Shirley means you have given loan. You have given, so it is an asset, right? Because you have to receive back. So you have given to someone, so it is an asset. You have to receive that money back. It is not loan from, it is loan to. It is an asset. So B, bank overdraft. Bank overdraft means you have taken temporary loan from bank. You have to pay liability. So fixtures and fittings, asset, something you have. So to use in business, asset. Computers also asset, you have something to use in business. We owe a supplier for goods. So we owe, no, it's a liability. Simply it's a liability. Whereas we own, we are owning it. So asset. Okay. So this one again you can do it as homework. This is homework. This is homework. So answers for this we will discuss in the next lesson or class. Next lesson or next class. Okay. Next class. It is the same lesson. So it is not next lesson. It is next class. We'll discuss this. So that is C1 P5 IGCSE. C1 P5. Okay. So state which of the following are wrongly classified. So which are wrongly classified assets? Loan from C. Satish. Loan from, you have taken loan. So it is a liability. It is wrongly classified. So it should not come here. It should come here. So cash in hand, it's correct. Machinery is correct. Creditor is wrong. So it is wrongly classified. It is not an asset, it is liability. Premises is an asset. Motor vehicle is an asset. So again, stock of goods. Stock of goods is an asset. Is something you have. Debtors. Debtors is also, it's something you owe. You own. Okay, something someone owes you.
What is asset? Asset is something you own and something that is owed to you. So debtors are paid customers and they owe you money. Money owing to bank. So this is correct. Okay. So this is how you just check the concept of whether you understood the concept of assets and liabilities. It's very important, very basic, but very important. So again, this one is homework. C1. Okay, so you see what is required here. So why is he setting up a new business? Okay, before actually selling anything, he bought a van for 4,500, a market stall for 2,000, and a stock of goods for 1,500. So van, market stall, stock. So put together, so 45, 2,000, 1,500. Okay. He did not pay in full for his stock of goods and still owes 1,000. He borrowed 5,000 from C Fox. These are the liabilities which he has to pay. So these are the assets which he has owned. Okay. Did not pay. He borrowed after the events just discussed and before starting goods. He has before trading starts, he has 400 cash in hand and 1,100 cash at bank. So these are all assets. Just see. So 4,500 is van, 2,000 is market stall, stock of goods is 1,500. So he did not pay 1,000, it's a liability. He borrowed 5,000 liability. So after the event just discussed before starting, he has 400 cash. Now 400 cash in hand and 1,100 in cash at bank. So these are all the assets. So just add them. 4,500 plus 2,000 plus 1,300 plus 1,300, 9,500. So this is 6,000. So what is capital? Capital is 3,500. Simple. Because assets is equal to liabilities plus capital. So capital is 3,500. Capital is 3,000. Okay. So this one you can write as homework in point detail. See how good the problems are. You can just understand and you can the concepts will be very clear. Drop G put his balance sheet from the following information as of 31st December 20 dash. Okay. So capital 72. So you have to draw balance sheet. Balance sheet means where the assets will be, where the liabilities will be. So liabilities, assets. So liabilities, assets. So what are the liabilities? So this is liabilities capital, right? So this is capital. Capital is 7,200. Debtors asset. Van asset. Creditors 1,600 liability. Creditors are suppliers to whom we have to pay credit. Fixtures asset 1,800. Stock of goods 4,200. Cash at bank 300. So these are the assets. This is liability, this is capital. So just see 1200 plus 3800 plus 1800 plus 4500 11 thousand this is 5 correct 11,300. So 7,200 plus 1,600 7,200 plus 1,600 8,800 minus 7,300 so 2,500. So capital is 2,500 another amount. Creditors 1,600 is correct, land 8,800 is correct, fixtures 1,800 is correct, stock of goods 4,200 is also correct, cash at bank 300 is also correct. Capital 7,200 is incorrect, creditors 1,600 is correct. So this is additional capital. So this one you can do it as homework. Complete the columns to show the effect of the following transactions. Okay, so this is accounting equation. So we will continue. So till here we will make it as part A. So this one will be part B. So we will start this in the next class. So till then, bye bye. Have a good day. So dear students, welcome back to Shasha's virtual classroom. So let us start with the next lesson, that is chapter 1B, 4B. Okay, so we had stopped, we had done in the previous class, we had done till here. So we will be starting with this. So complete the columns to show the effect of the following transactions. So basically this is related to accounting equation question. So complete the column to show the effect of the following transactions. So we pay a creditor 70 in cash. So we pay a creditor $70 in cash. So what happens when we pay a creditor 70 in cash? Obviously, who is creditor? Creditor is a liability, no? So creditor is a liability. So liability will come down by 70. So all the amounts are in pounds. So pound 70. So what is the other effect? Even the assets, even the cash will come out because cash will fall because we are paying. So cash is going out to pay sundry creditors. So both cash is going out and liability is paid off. So both will come down. So it will not have any effect on capital because there is no profit element or loss element. So it will not affect the capital account. Okay. What fixtures pound 200 paid by check? What fixtures pound 200 paid by check? So what's happening here? So see, asset will come in. So what is the asset? Fixture will come in. Fixture will come in, that is 200 will come in. This is fixture. And money will go out. So money will go out from bank. So it is also 200. So bank 200
200 will go to bank. So what is the net effect? Net effect is nil at all. So there is no effect on assets because one asset is increasing, the other asset is decreasing. So there is no effect on assets. No effect on liabilities as well. No effect on capital. Bought goods on credit 275. Okay, bought goods on credit. So what will happen? So stock will increase. So inventories, goods. Okay, inventories, goods or stock, whatever you call it as. So they will increase. This plus. Okay. So liabilities also will decrease because we have to pay. You have to pay them later on. So creditor on credit means you have to pay them later on. Even this will increase. This also will increase. So you can say this is coming down. This is going up. Assets are also going up. Liabilities are also going up. So this is coming down. Liabilities are also coming down. So for the second one, there is no. Okay. So then the proprietor introduces another 500 cash into the firm. So what is happening here? Cash is increasing. So 500 pounds are increasing because the cash is coming into the business, right? 500 pounds are coming in. So similarly, capital is also increasing. So 500. So capital is also increasing. It is also increasing 500. J. Walker lends the firm 200 in cash. So what is happening here? Walker is a person who is a lender who is giving. So it's a liability. So again, cash is increasing. So cash is increasing by 200. Cash is increasing by 200. And even loan liability. Okay, liability is a loan. We have to pay back. No, if we take money from J. Walker, we have to pay him back, right? So we have to pay him back 200 rupees. So interest is another issue that is a different aspect. So we have to record it separately. But as of now, cash will also increase and liabilities also will increase. At the top is US dollar 50 by check. Okay. So what is happening? At the top is by check. At the top, who is at the top? The top is a customer to whom we have sold goods on credit. So he has paid us money. So what will happen? The top cash will come in. No. So bank account will increase. So bank account will increase by 50 bucks. Bank account will increase by 50 bucks. Bank. So, and what will happen? The top pays off. He had to pay us. So his account will come down. That is debtor. So both are assets. So one asset is increasing, other asset is decreasing. So the net effect is nil. So the net effect is nil. Okay, so then we return goods costing $60 to supplier whose bill we had not paid. We return goods costing 60. We return goods. So what is happening? Goods are going out back to supplier. So goods are going out. Goods are going out. Stock, inventory is going out. And whom we are giving it back? To a supplier. Supplier, who is supplier? Supplier is a liability from whom we have purchased goods on credit. So even that will come down, right? So even that will come down. So capital account it will not hit. So capital account it will not hit. Okay. So then bought additional shop premises paying 5,000 by check. So what is happening here? Money is in premises is increasing, whereas bank account is decreasing. So there is one increase of an asset, there is decrease of another liability. I mean the same asset. So asset is increasing, one asset is increasing. Which asset is increasing? Premises is increasing, whereas check, and that is bank. Okay. So bank is decreasing. So the effect is, net effect is nil because it is hitting both the accounts are hitting asset account itself. So there is no effect on liabilities, no effect on capital. So this is what is this one. So what you can do is you can just try this question, complete the columns to show the effect of following transactions, and this is a homework. Okay, so this is a homework for you. Please try doing this so that if you have any doubts, please let me know so that so maybe we will work out the solutions in class. What do you say? C1, P5 or C1, P6 if you want. Okay, so unless otherwise you let me know, I'm not going to do this. It is assumed that you can do this on your own. So sorry, but I need you also to try this problem on your own. So otherwise, and there is no point in me doing everything and just you are watching like a movie. So that's not going to happen. So you have to put your efforts and you have to let me know that even if one comment down in the section of this video will make me happy. So I will be happy to post the answers for this. Okay. So next question. Okay, so 1.13. So that is G. Brown has the following items in her balance sheet as on 30th April 20 dash capital 18,400, creditors 2,100, fixtures 2,800, car 3,900, stock of goods 4,550. So debtors 2,780, cash at bank 6,250, cash in hand 220. So during the first week of May 20-8, she bought extra stock for goods 400. One of the debtors paid to 920 by check. She bought a computer by check, pound 850. You are asked to drop the balance sheet as on 7th May 20-8 after the above transactions have been completed. So you are supposed to drop the balance sheet. You are supposed to drop a balance sheet. Okay, so let us see how to prepare a balance sheet. Okay, so this is all the information that has been given in the question. So these are the assets and these are the liabilities there. So they are asking you to prepare the balance sheet. Okay, she bought extra stock for goods 400 on credit. So she bought extra stock. So stock means this one 450. How much? Worth 400. On credit means plus 400. So this will increase and this will increase. Both creditors and stock will increase. Next one. One of the debtors paid 920 by check. One of the debtors paid 920 by check. So one of the debtors paid 920 by check. So this will come down, but this will increase. So 920. So then the next one. So what is it? She bought a computer by check 850. She bought a computer. Okay, so computer is not there. Computer. $850 by check. So 850. So minus 850. Minus. So this is the new balance sheet. So the net effect. So this will become 2500. So this will become 2500. So you can just so this will become 4950. So 2780 minus 920 is how much? 60. 7 minus 9, 8. 7 minus 9 is 6. 70. So that I don't commit a mistake again. So take some time, don't commit silly mistakes. 2780 minus 920, 1860. 1860. 1860. So this will become bank balance will be 6250 plus 920 minus 850. 6250 plus 920 minus 850. So 6320, this will become 6320. So all other figures will remain same. So this is the answer for this question. So whatever question has been asked, this is the answer. This is how you have to do the problem. Always liabilities will come on the left side and assets will come on the right side, or you can write one below the other. So whatever it is suggested by your school teacher, you can do it. So it can be presented in different ways. The ultimate amount is the net amount, the net result. Okay. So this is over. So then this problem is done. So you can try the next problem. This problem is as a homework. So you can try this problem as a homework. Then you can get back. So okay, so it's the end of the lesson. So we have done almost all questions from this lesson. So this one you can try on your own. And please let me know if you have any doubts. Please let me know as a comment. You can look for the solutions in C1, P5 or C1, P6 in the next class. So in case you have any doubts or if you found any mistakes, Indonesian, please let me know. Even we are humans and mistakes, silly mistakes are going to happen, but intentionally nothing will be taught wrong. So you can be rest assured. So all the best. So we will catch up in the next class. Dear students, welcome to Shasha's virtual classroom. So this is a book by Catherine Kukom. So chapter lesson number C1 P4. So C1 P4 A and D we have discussed Frankfurt's book. So the same concepts are discussed even in this. This is Catherine Kukom, it's from Catherine Kukom. Okay, so define the term bookkeeping. So define the term bookkeeping. So definition you need to learn. Definitions you have to write as it is dictated. So you can say bookkeeping is a process of detailed recording of all financial transactions of the business. So this is what is bookkeeping. The next question is what is accounting? Accounting is a bookkeeping records. Uses the bookkeeping records to prepare the financial statements such as the records. So the next question is why should you prepare financial statements? So the progress can be measured by comparing the financial statements done here with previous years so the single calculations. Ratios, the information provided shows so many things. So it's a simple question and a simple answer you might have. So it's a very small thing. So state what is included in the term financial statement. So financial statements include income statement and position statement, or we call it as a profit and loss account and a balance sheet. Okay. So then assets, liabilities, and capital. So see the question here. So what are assets? Assets are something which the business owes and which is owed to business. So that is what is assets. So what are liabilities? Liabilities is something which is owed by business. So which the business has to pay back. So suppose you have taken loan. So that is what is liability. So you have taken back loan, you have to pay back. So that is what is liability. So you have purchased goods on credit, you have to pay back the money. So that is what is liability. So what are assets? Assets is something you have like land, land here you need for purpose of doing the business. Maybe you have machinery to manufacture. So that is what is asset. So we are using it, keeping it in the business to use it for some period. So that is what it's called asset. Asset is something. It is a resource controlled by an enterprise from which future benefits are expected to flow. So it is something which is owed to you and which you own. Okay. So what is capital? Capital is nothing but the investment made by the owner into the business. So that is what is called capital. This we have already discussed in lesson number 1 in detail. So very small thing, you fill in the missing figures in the following table. Okay, so what is this? The difference between this and this. So you know the accounting equation, right? What is the accounting equation? The accounting equation is assets is equal to liabilities plus capital. So, right? So what is the accounting equation? Assets is equal to liabilities plus capital. So this is the accounting equation. You have to remember this. So it means what this minus this will be this, right? So 35,000 minus 12,000 from the 35,000 minus 12,000. 22,000 pounds. So capital will be 22,000. Very simple. It's very simple thing. So capital, what are the assets in this case? They are given both the sides. So 300, that is 700. So 19,000 plus 44. 19, 44. 63,700. So it is 63,700.
700. So in this case, what it is? So assets minus capital is liabilities. So 67,300 minus 12,300. So very simple. So very easy. It's very easy. I think you have understood. So you might have done this on your own. So even then, just for your confidence, I'm doing it. So that it's very easy concept, simple concept. Okay. So then. Give two examples of each of the following, excluding short element of excluding those shown in on asset. So other than this means cash. Okay, so cash is not mentioned here, it's so asset means cash. Give two examples. So cash can be one example. What can be the other example? Furniture is not in, right? So furniture. So here, what are the other example of liability? Bank loan. So what can be the other example of other one more liability? So loan from friend. Okay. From whomever you are taking, you have to pay it back. No? So it's a liability. Explain the meaning of each of the following terms. Trade payable. So what is trade payable? Trade payable is nothing but when you purchase goods on credit, at the time you have to pay back. No? So that is what is trade payable. So what is trade receivable? When you sell on credit, at the time you have to receive at the need of the customer. So this is the money payable to supplier. This is the money receivable from customer. So let us check. There are some exam style questions. Maybe like these are MCQs which keep appearing in the MCQs. Which task is performed by a bookkeeper? So analyzing the trading results, no. Entering transactions in the ledger, yes. Preparing year-end financial statements, no. Providing information for decision making, no. So which task is performed? So entering transactions in the ledger. This is the only thing which is available. They will not do any of the other things. They will not do any of the other things. The trader provided the following information: premises 180,000, inventory 23,420, trade payables 26,180, trade receivables 21,710, other fixtures 32,600, loan from bank 80,000, cash in bank 2,450, motor vehicles 15,900. Calculate the value of the assets. So what are the assets? So this is an asset. This is an asset. So this is an asset. This is an asset. So this is also asset, this is also asset. So these are all assets, okay? So simply add this. So what you get is the sum of the assets, okay? So this is asset, so this is asset, so this is asset, this is asset. So then calculate the value of the liabilities. Value of the liabilities. So what are the liabilities? This one, loan from bank, or the liabilities, okay? So these are the liabilities. So this is L liability and this is L liability. Trade payables is a liability, loan from bank is a liability. Use the accounting equation to calculate trader's capital. So add all the assets. You see what are the assets? Let us just check what are the assets. 180,000 plus 23,420 plus 21,710 plus 32,600 plus 2,550 plus 15,900. 276, 180. 276, 180. Assets are 276, 180. So what are liabilities? So pound, okay, so on dollar, so $20. Always in dollars. Liabilities is how much? 26,180 plus 80,000. So 106,180. So 106,180. So what will be the capital? This minus. So that is what is capital. So 276,180. So it will be 70. Yes, 70,000. 70,000. This 7%. So 2 minus 1 is 1. So 170,000. Okay, 170,000 is the capital. Which is a statement of financial position? The calculation of amount owed to owners of the business, a list of assets and liabilities of the business on a certain date. Yes, a list of everything owned and owed to a business, a summary of money paid to and received by business. Now, a list of assets and liabilities of business on a certain date. So this is what is financial position. So then a business had $94.20 on its bank account. The following transactions took place. Bought goods on credit. This will not hit the bank account. This will not hit the bank account. So sold goods on credit. This also will not hit the bank account. Repaid a loan by check. So money will go out. So 9,540 minus 5,000 will be 4,000. So 9,420 minus 5,000 is 4,420. This one. So answer is this one. Okay. So that's all. Complete the following to be able to show the effect of the following transactions. The first has been completed. As an example, bought a motor vehicle and paid by check. So what are the two items that are hit? Motor vehicle and bank. So motor vehicle increases and bank decreases. Just because when you buy a motor vehicle will come in and you have to pay money, right? So when you pay money will go out. So effect on liabilities, no effect on liabilities. There is no effect on liabilities at all. So this is how you have to do. It's very simple thing. So I think you can try on your own. So I will give you just a minute so you can take a screenshot. You take a screenshot of this question. Try it and we'll just discuss it. Okay. So just try on your own. It's a very simple thing. So if you don't understand, then you can do. See, this is how you have to learn. Otherwise, you don't watch the problem as a movie. Like just you keep seeing the movie, you'll not understand anything. Afterwards, when you start doing it, you'll get lot of doubts. No, you should never do that. So always what you have to do is you have to start doing the problem. Actually, you have to start and sit and write down. Put it on pen and paper. Please put it on pen and paper. So please write down wherever, but you have to write down. You have to do the problem. Actually do it. So okay, actually do it, and then check the result whether you've done everything correctly. Okay. So bought goods on credit from a credit supplier. So what are the two items that are affected? One is inventory. What is happening to inventory? Inventory is coming in. Inventory or goods. Okay. So it is called inventory, or they are also called as goods or merchandise or stock or whatever. So it is called by different names. So it is called inventory. So then what is happening? Credit supplier. So we are purchasing from credit supplier. So creditor. So bills payable. So it is known as accounts payable. Okay, it is also known as account payable. So what is happening? Inventory is increasing. So inventory is increasing. So creditor is also increasing. So both are increasing. So there is no effect on. So here liabilities is here, right? So creditors will write here. Creditors, they also increase. Okay. Then received a check from credit customer. Received a check from credit customer. So what is happening here? You are receiving money and it is a customer. So both are assets. So you are receiving money. So you are receiving check. So bank account. So bank balance is increasing. So bank balance is increasing because money is coming in. And debtor is also an asset, right? So debtor is a customer. So he has to pay you money. So debtor is also customer, but he is decreasing. Why? Because he's given you money. So he's paid you money. So that's why it decreases. There is no effect on liabilities. Sold goods on credit. When you sell goods on credit, what happens? Stock. So that is inventory, goods, stock, whatever you name it, call it as. So why I'm telling, because inventory is often used in A levels and all. So goods are often used, it is interchangeably used, and stock is also used. Okay, so anything, it is one and the same thing. It is nothing but the merchandise. Okay, so it is merchandise. So what happens when you sell the merchandise goods? The goods go also. So the goods or inventory, we call it as. So we can use the word inventory. So inventory, what is happening to inventory when you sell? When you sell, inventory will go out, right? So inventory will decrease. No, so inventory will decrease. So what will happen? Sold goods on credit. So inventory will decrease. But have you received the money? No, you have not received the money. Then what you have to receive the money in future. So a person has to pay you back. So one person to whom you have sold, he has to pay you back. So he has to pay. So it increases the receivables. So debtor, or it's called account receivable. Okay. So this is called accounts payable. So this is called accounts receivable. Okay, so accounts receivable. So in A level and all, most of the time we'll be using accounts receivable. So then, sold goods on credit, paid off loan in cash. So what is happening here? Cash is going out. Cash is an asset. Cash is going out. Cash is decreasing. So there is decrease in cash. So paid off loan in cash. So what is happening? Loan is also coming down. So loan is also decreasing because you have paid. Loan decrease. Okay. So that's all. So this is how you have to do. So very simple logical. If you want more problems, if you want me to explain more problems, so please let me know. Don't feel shy, even if it is a very silly doubt, please let me know so that we will discuss. I will explain to you in detail so that you understand the concept. This is very simple concept, but very important concept, so that you don't commit errors in the. Otherwise, you will struggle in the future. Like when you do if you move ahead, you will have to struggle a lot. So please don't do that. Okay, try to understand. And if you have any doubts, even if it is a very silly mistake, don't think that you will look like an idiot. So please ask me. So I will explain to you. So again, in different ways, if any problem or anything that you have any specific problem, also please let me know. So we'll discuss it. Okay. So don't worry. The financial statement of Bhavani Traders is given below. So statement of financial position, they have given assets and they have given liabilities. So here see, the assets they have given this side and liabilities they have given this side. So whereas in previous problem, that is chapter 1 P4, I wrote liabilities this side, asset this side. So that is another thing, like this is the actual way you have to write. This is assets always you have to write this side and liabilities you have to write this side. So please keep in mind. Okay. So ultimately the figures matter, and even this also matters a lot, because this is how we have to write. Assets will come this side and liabilities will come this side. On 1st November 2014, the following transactions took place. A check for 3,000 was paid on to a credit supplier. A credit customer paid $500 in cash. A loan for 8,000 which was paid into bank was received from London Limited. A check for 7,000 was paid for an additional machine. Prepare the statement of financial position of Bhavani Traders on 1st November 2014. The above transactions have taken place. Prepare the statement of financial position of Bhavani traders after the above transactions have taken place. So how do you do that? So basically you have to analyze what is happening. So on 1st November 24, the following transactions took place. A check for 3,000 was paid to a credit supplier. So you have paid a check. So minus 3,000 from this, minus 3,000 from this. Okay. Then a credit customer paid 500 in cash. Credit customer paid 500 in cash. 500. So credit customer paid 500 in cash. So customer, where is customer? Trade receivable is customer. So this will come down. So this will increase. Then a loan for 8,000 which had been paid into bank was received from lenders limited. A loan for 8,000 which was paid into bank. So it is increasing. 8,000. So lenders limited. Okay. So because it is not for trade payables, it is a loan. Lenders limited. So how much it is? 8,000. So then was received from lenders. The check for 7,000 was paid for an additional machine. Check was paid for additional machine. So machine is coming in. How much? Worth 7,000. Machine is coming in, and cash money is going out from bank. So money is going out from bank. So that is 7,000. So what will be the effect of this? So this will become 5,000. So this will be 35,000. This will be same. This will become 5,000. This will be 8,000. So lenders limited one adding will come. So machinery, this will become 19 plus 7, 26,000. So this will be 6,000 itself. This will be 4,900. So this will become 2,500. So this will become 2,500. So this will become 10,100 plus 8,000 plus 1,000 minus 3,000 . 7,000 10,100 minus 3,000 plus 1,000. So it will be 8,100. So the cash in bank will become 8,100. So cash in hand will become 500. So then this total will change. This total will be 40,000. So this side also total will be 40,000. Okay, so this is how I include this. So this is a very simple problem, very easy. Okay then. So this chapter is done. So this is C1, P5. Then, so we'll see in the next class. Let's catch up in the next class with the next lesson. Till then, keep practicing, keep learning. So if you have any doubts, please let me know. So we can always discuss. Even if it is a very silly doubt, please let me know. So just write a comment in the section. So I will be very happy to help you. So we are here to help you. So please learn and please do good in your life. So all the best. Okay. Bye. Dear students, since we already discussed the theoretical aspects in the previous lesson, so chapter 1 IGCSE, so we'll do some practical questions so that the concepts are clear. Okay. So complete the following table. Bought office machinery on credit from DSR Limited. So what is happening here? What you are supposed to do? Complete the following table. Accounts to be debited, account to be credited. Bought office furniture or bought office machinery on credit from DSR Limited. So which account will be debited? Office machinery account will be debited. Why office machinery account will be debited? Because machinery is coming in, right? So machinery, office machinery is an asset. So what is the rule? Debit what comes in? Okay, so debit what comes in. That is the rule, right? So what is the rule? Debit what comes in? Debit what is received or debit what is received. So machinery is received. When you buy office machinery, obviously office machinery is received. So office machinery. Okay, office machinery is received. On credit from DSR. See, this is how you have to break the transaction for you to understand. Okay, so break the transaction for you to understand. So the concept is clear. From DSR. So who is DSR? DSR is the person who is giving machine, right? So he is giving machine. He is giving machine to the business. So DSR should be credited. Isaac. Isaac Limited will be credited. The proprietor paid a creditor C. Jones from his private funds. So what's happening here? So proprietor paid a creditor C. Jones from his private funds. So he's paying from owner is paying out of his private funds. So money is going out. But who is receiving? Creditor. Creditor Mr. C. Jones. Creditor C. Jones. Okay. Creditor C. Jones is receiving. So C. Jones account will be debited. Why? He is receiving. Okay. C. Jones account will be debited because he is receiving. So he is receiving, no? So C. Jones is receiving. So who is the giver? So giver is the owner. So it is the capital owner. Okay. So capital. When the owner gives, we should never write the owner's name, but we have to write it as capital. So we have to write it as capital. So because it is proprietor who is paying the money. So a debtor N Fox paid us in cash. So what is happening? Cash is coming in. Cash is coming in. What is received? Cash is being received. Cash is being received. So who is giving? Fox is the person who is giving. So N Fox is the person who is giving. So N Fox will be credited because he is the giving. He is the person who is giving. So then repaid part of loan by Exeter by check. So what is happening here? Money is going out of bank. Repaid part of loan by Exeter by check. So money is going out of bank. So what you have to do? Bank account will be credited. And paid part of loan from P Exeter by check. So we have paid P Exeter. So who is P Exeter? What is he doing? He is receiving. So he is receiving. Debit the person who is receiving. Debit the person who is receiving. So it is P Exeter. So return some office machinery to DSR. So exactly reverse it. That's all. So office machinery to DSR. So DSR will be debited because he is receiving now. Earlier he had given, now he will be receiving. So DSR will be debited and machinery will be credited. Why machinery is going out, is given. So that is given out, given away. So a debtor only pays us by check. So what is happening? Money is coming into bank. Money is coming into bank, and who is giving? Lending is giving. And lending is giving. So he is the person who is giving. So bank we are receiving. So what is received? Money is being received in bank. Bought van by cash. So what is happening? Van is coming in. Van is being received and cash is being given. So remember the rules, accounting rules. So and then do the problem. So now the concept should be clear to you. So we'll catch up, or you can do this as a homework. So you can do this as homework. So suppose you have any doubts, you can ask. You can put a query in the comments to this class in the video. So I will definitely explain this. So you can have a look at this question. So here, complete the following table: accounts to be debited, accounts to be credited. Bought lorry for cash. Bought lorry for cash. Paid creditor to late by check. Repaid P loan by cash. Paid salary. Repaid P loan cash by cash. Sold lorry for cash. Bought office machinery on credit from Ultra Limited. A debtor E pays us by cash. A debtor J Cross pays us by check. Proprietor puts a further amount into the business by check. A loan of 200 in cash is received from LO. So paid a creditor D not by cash. So try this question on your own. So don't try to copy. So please try, understand, because this is very important concept. Otherwise, going further, you will struggle to understand. So ultimately, you may not understand and you will face difficulties. So please try to understand. So and do the problem. And if you have any doubts, please let me know as a comment in the comment section. Till then, have a good day.
Pe august poți primi sub formă de cupon de 3 ori valoarea TVA-ului, adică 33% reducere la cașcaval ambalat și hrană pentru animale și de 2 ori valoarea TVA-ului, adică 42% reducere la bagaje. Detalii în regulamentul disponibil pe carrefour.ro. Carrefour.
जानिए मेरे दिल को पार करे खुदाया होश मेरा कैसे तूने उड़ाए खुदाया जिक्र तेरा होठों पे क्यों आए ओ सजना सजना ओ सजना सजना खुद से बिछड़ना मुझको अच्छा लगा है तुझ में बिखरना मुझको सच्चा लगा है पूरा था मैं अब पूरा हुआ जब से तू मेरा हो गया मनमानियों से है नजारे क्या दरमिया है ये हमारे दिल कागज का एक पंछी तू अंबर सा है तुझे जो देखे ये फुर उड़ ही जाए बादल जैसे बस तुमसे प्यार करे तेरी जानिए तुझे ना पता जानिए ऐसा नशा जानिए मेरे दिल पे वार करे तू मेरा पहली दफा मिलके लगा तूने छुआ सपनों में मरहम दिल पे लगा मांझा तेरा तेज ये दिल की पतंग को काटे हर तुझी से हटके गिरे तेरी शक्ल आके तुझसे दिल लगाए जो उर्दू ना भी आए तो शख्स हो शायरी करने लगता है कि कोई इतना खूबसूरत कोई इतना खूबसूरत कोई इतना खूबसूरत कैसे हो सकता है बादल है थोड़े बादल है भीगे बरसे भीगे आ जरा अखियां तेरी मेरे दिल पे वार करे तेरी जानिए तुझे ना पता जानिए ऐसा नशा जानिए मेरे दिल को पार करे ना जो ये तेरा साथ है हम पर तेरे होठों पे तेरी बात है चाहूंगा तो मैं अब पूरा हुआ जब से तू मेरा हो गया
तुझको ही बस देख कर बोले मुझको ही मेरी नजर तुझको शायद नहीं है खबर तुझको जीते हैं हम किस तरह देखो ना जुल्फों से कैसे जुल्फों से तेरी छुपती प्यारी प्यारी सी मुस्कान है और नजरें झुकी और नजरें उठी तो मैं क्या ही करूं बर्बाद मैं सारी रात आहे भरता पल यादों में भरता माने ना मेरी मन मेरा थोड़ी थोड़ी होश मदहोशी सी है नींद बेहोशी सी है जाने कुछ भी ना मन मेरा और आओगे ऐसे आओगे तेरी मेरी क्या राहें उजड़ी है और राहों में जो तुम आए कभी हम तो प्यार से ही मर जाएंगे क्या यूं खफा आजा इस दिल की बेताबी रुकी हुई है नाराजी है ताज़ी पूछे तू कि तुझ में मैं क्या देखता हूँ जब चारों तरफ आज कितने सारे नजारे हैं जाने ना तू खुद को यूं ना जाने क्यों नजरों से मेरे यहाँ देखो ना खुद को जरा वो तेरे होठों को जिनसे रखते मेरे प्यारे प्यारे नाम है और दिल का तेरे और दिल का तेरे अब मैं क्या ही कहूँ क्या बात है तेरी कोशिशों में शामिल जो खुशी है नाराज़ी है ताज़ी और छुपी हुई है ओ नाराज़ी है ताज़ी जुड़े जो तेरे नाम से तो टूटे हम नींद से ये कैसा तेरा इश्क है साजना समाया मेरे दिल पर वो छाया मेरे मुझ में वो ऐसे जैसे जान तेरे बरसात में पानी जैसे कोई कहानी जैसे दिल से हो दिल तक जो बयां दुआओं में तो है क्यों नहीं लकीरों में ये कैसा तेरा इश्क है साजना और आओगे ऐसे आओगे तेरी मेरी क्या राहें उजड़ी हैं और राहों में जो तुम आए कभी हम तो प्यार से ही मर जाएंगे आशिक दिल तेरा पुराना है ये दीवाना दीवाना समझे ना देखो ना जुल्फों से कैसे जुल्फों से तेरी छुपती प्यारी प्यारी सी मुस्कान है और नजरें
जब से मिली तुझको देखा नया रंग है यारी सी है ज्यादा प्यार से कम है इससे ज्यादा कैसे कहूँ मैं दिल समझने पाता मांगे तेरी छोड़ दिया
होंगे ख्यालों में जहाँ जहाँ साया तेरा चाहे रहना जगा जगा देखे तुझे तारों के हवाओं में जहाँ जहाँ पाए तुझे